FEMA officials are trying to dispel misinformation about the recovery effort in Maui. FEMA spokesperson John Mills.
It's important to remember the state is in charge. Maui County is executing the disaster response, and FEMA is coordinating federal support. So FEMA is not in charge and in no way taking over.
Meanwhile, the head of the Maui Emergency Management Agency has resigned after facing criticism for not activating disaster sirens during last week's deadly wildfires that killed at least 111 people. Hurricane Hilary has strengthened into a major Category 4 storm off Mexico's Pacific coast. It could bring heavy rain to the southwestern U.S. by the weekend. A Mississippi judge has cited police errors in declaring a mistrial for two white men accused of chasing and shooting at a black FedEx employee who was making a delivery. Brandon Case and his father, Gregory Case, are charged with attempted first-degree murder, conspiracy, and shooting into the vehicle driven by DeMontario Gibson in January of 2022. Judge David Strong said he made the decision because of errors by a Brookhaven Police Department detective. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt.
All right, Michael Barr, thank you so much. We appreciate it. Matt and I love the big take stories on the Bloomberg terminal coming out of Bloomberg News daily. Just these really in-depth, deeply reported stories of some really cool topics. Today's a good one. Abandoned electric cars are piling up across China.
Oh, yeah.
I mean, it's just, they got some great video in the story.
Unbelievable.
Apparently, I mean, it kind of reminds me of the electric bikes from 2018 when, like, tens of millions of bikes ended up in rivers, ditches, and disused parking lots after the rise and fall of startups backed by big tech companies.
But this seems far worse for the environment.
Yes.
I mean, the story points out that building an electric car in these lots, hundreds upon hundreds of abandoned electric vehicles with their batteries in them,
yes.
right? So they're holding all the cobalt and lithium and stuff that, you know, we mine in horrific ways in the Congo, right? And is also becoming scarce. It's just the worst waste, and it just kind of makes you question the push for electric vehicles.
Yeah, I mean, in China, we've seen this before, and you just wonder, I mean, like, these startups crank out these new vehicles and they become obsolete, or there just isn't the demand there, and you got a problem with what to do with them all. And so that's certainly been an issue in China. So this is a big take story. Go check it out on the Bloomberg terminal. Good reporting there. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Big hour coming up. This is going to be Matt's favorite hour of the day, I think, because we're going to start off with Bitcoin. It's off almost 6% today, so we're going to check in with the king of South Beach, Mike McGlone, senior macro strategist with Bloomberg Intelligence. He's going to tell us what's happening there. And then the highlight of the week, Joe Mysak. Municipal bonds. Yes, right. It is Friday.
I've been waiting.
I know you have. It is Friday. Like so we're talking muni bonds. And then David Kudla, founder, CEO, and Chief Investment Officer at Mainstay Capital Management. He's going to give us his thoughts on these markets. That's all coming up. But first, let's kick it all off with Denise Pellegrini.
Yeah, Paul, let's talk about this crypto crisis, as some are calling it. Worries that rising interest rates could really hurt things. That's sparking this sell-off. And, you know, the sell-off has pushed Bitcoin from near 29,000 to, we had as low as 25,314 in just a 24-hour span. CoinGlass says In that period, more than $1 billion of positions were actually unwound in that sell-off. Right now, though, we're a little bit improved, though. Bitcoin at about 26,023. Still, though, down almost 6% on the day in the U.S. trading session. Also, some concerns overall about financial markets and rising yields. But Ed Yardeni, president of Yardeni Research, says really what's happening now is the bond vigilantes are back, and he says they're saddling up.
Look, usually the bond market is driven by inflation expectations, and what everybody expects the Fed to do about inflation. Usually supply and demand really don't matter that much, and that's usually because federal deficits tend to widen during recessions when the Fed's lowering interest rates. This time around, we've got the federal deficit widening when the economy is doing well, and I think the bond vigilantes are quite concerned about that, way too much supply.
And Yardeni there on the Bloomberg Surveillance podcast. The yield on the 10-year right now, 4.2%. Stocks, well, the Dow just turned positive, but only slightly. It's up about 3 points. That's up fractionally. The S&P 500 still lower, down about 0.2%, 10 points. The NASDAQ down about 0.6%, down 74 points. NYMEX crude right now, it is trading lower, down about 0.2%, 80.25 a barrel. Spot gold, it's up about 0.2%, 19.42 an ounce. Deere shares down about 5%. They boosted their annual forecast. Still some concerns about slumping crop prices and what it could do to them. And guys, it's Friday, so here's your weekend boozy brunch party tips, just in time for National Waffle Day next week. The folks who make Eggo waffles, well, they are now teaming up with Sugarland's Distilling Company to make a new liqueur. This is called Eggo Brunch in a Jar. Cream liqueur with the flavor of buttery toasted Eggo waffles, bacon, and maple syrup. I don't know. At least you can drink this product better than the bacon perfume we were talking about last time.
Yeah, bacon perfume is a big no, but I would definitely try this. And I don't even drink anymore.
Right? You're having a party this weekend. I say, try it out.
It sounds delicious. Yeah, I'll bring it to the party. By the way, you're all invited.
What time?
Party at Matt's.
2 p.m.
Right.
We're gonna barbecue at my place, and then we're gonna go watch the new movie Strays at the Alamo Draft House.
Oh, nice.
Look at you. Getting all social up there in Westchester. All right, Denise Pellegrini, thank you so much. We appreciate it. Bitcoin off 5.6%, as Denise was just reporting, 26,090. People are heading for the exits here. I'm going to check in with the king of South Beach, Mike McGlone, senior macro strategist with Bloomberg Intelligence. Mike, what's happening out there with Bitcoin?
You always bring me on, and I start laughing from those South Beach connotations. So I appreciate that. I appreciate that, Paul. Bitcoin is, I think, resuming a bear market. And I look at it. The headline I put out today is, to me, it appears similar to the U.S. stock market in 1930, when it rolled over. And then it kept going down after it bounced. And the key thing about it is, let's just look at Bitcoin right before this COVID, right before the biggest pump in liquidity in history. It was around 10,000, and still right now it's around 26. So I think there's risk it can head that way. It's the leading indicator. It's one of the most world's speculative digital assets, most significant. But I think that leading indicator is what to me is important for the rest of the market, like the stock market. The key to me headwind is just look at that U.S. government 2-year note. You can purchase a 2-year note around 5%, lock up almost 10% in 2 years. First time you've been able to do that since about 2007. I look at it, every rational person in the planet who's got money and is invested is looking at that and saying, thank you, I'll do that. And I think that's what's happening with all risk assets, and it's just getting started.
Is there a concern that Elon Musk has sold a ton of Bitcoin? Didn't I read that somewhere?
Yeah, I thought he sold already. I heard SpaceX today, but this is a problem, I think, with Bitcoin. I think in this case, some of these leveraged longs that brought right when the BlackRock announced that they were going to apply for an ETF, it hasn't been approved. The market rallied from about 25,000 to just above 30. We got a lot of leveraged longs in there. I think we're stopping those people out, and they're getting long for the wrong reason, with the hopium that you're going to get an ETF. To me, it's the fundamentals. Yeah, well, it's a word I learned from Bitcoin people and crypto people. It's that hopium, and so now it's a question of what stops this downward trajectory. So one thing I pointed out, I published today, if you just look at a 100-week moving average of Bitcoin, it's rolled over and it's trending downward for the highest velocity ever. Now Bitcoin's only been around about 14 years, and then I think to myself, what stops just normal reversion of the best performing asset ever? And number one thing is the Fed is still tightening. The Fed is still telling you, it's still taking liquidity away. And here's a highly speculative asset that went up a lot. I still think that's the risk it continues to revert.
Mike, this sounds for Bitcoin, from what I'm hearing from you, more of a technical kind of thing. Do I look at charts? Do I see where a technical bottom is here? Do I start doing that kind of thing?
Well, I view it as the opposite. I was just on a call, and they're pointing all the technicals. People trade it too much. I view it as number one headline is the Fed is still tightening. And then you try to put it into things that we see as humans. We can't really, can see the tightening, can feel, but you can watch the price. And I just point out trends down, Fed's tightening. Use the discipline of a good investor. Respect the trend. So as far as where it can go, I think people are looking at 25,000 as the first level, and then of course looked at 20,000. I mentioned a level I think it could go back to in a normal recessionary environment, which is the view of Anna Wong, our chief economist. We should be heading towards a recession, which is the indication from the inverted yield curve. And why not go back to 10,000? That's where it was before the Fed. Well, that's where it was hovering around 10,000 right before this massive pump in liquidity with the COVID. Now that liquidity is going away at a breakneck pace. Bottom line is all the lessons of history in assets that pump on liquidity, and when that liquidity goes away, that lessons are that assets usually revert. It's a question of how far.
Where do you expect to see Bitcoin in the coming years? I mean, is it possible that we drop back down to 16,000 or even test those limits again?
Yeah, so I think it has a bottom around 15, and most people look at that as, I'm going to be buying here or getting near there, and that is the risk I see. Is the bottom line for me, Matt, is this is part of the macro. It just a good indication that I think we're heading into a more significant bear market. If you look at the stock market, it typically doesn't bottom until about 2 years after the Fed starts easing. We haven't done that. They're still tightening. And to me, this is part of this is the leading indicator. So I don't know how long it takes, but like I said, I compared it to the stock market in 1930, and right now it's a bear market. It's heading lower, and the Fed's still tightening. So I don't even see light at the end of the tunnel for risk assets to bottom, and Bitcoin is just the best leading indicator.
All right, so aside from Bitcoin, what's the if I go to BI commodity, what are some of the top 2 or 3 things you guys are working on?
Well, I'm still watching crude oil. Now, crude oil is hovering about unchanged in the year. Obviously, I'm still bearish crude oil. And a normal trajectory after the pump last year is you typically head towards 2 cheap levels. 2 cheap levels in crude oil, not at 80. It's around 40 or 50. And then you look at the macro of it. China is clearly in decline. And what stops this downward revision in economic outlook for China? I don't see it. Now, we should expect stimulus from there, but they just upset their biggest export customers, Europe and the U.S., with this war. And it's not really China anymore. It's one leader, President Xi. So I think you're seeing a situation in China similar to peak Soviet Union and peak Japan in the late 80s, early 90s. So there's a demand side. And great, and that's still going that way. And you look at copper. Copper is pointing that way. Copper's tilting lower. It's right around $3.70 a pound. Its average price for last year, 20 years, is $3 a pound. Now, that shows deflationary forces overall. And I don't see what stops it from going that level. You have to see a major pickup in China. You have to see major weakness in the U.S. dollar and Fed easing, typically. They're all going the wrong way at the moment. So I look at this as the early days of a bear market. And then you have to ask yourself is just what happens to all these assets if the U.S. stock market rolls over for a normal recession? And typically it doesn't bottom until we're well into an easing cycle. We're still tightening.
So when you're out at the clubbing, South Beach, you don't talk commodities, do you, Mike? Please tell me you got a better game than that.
Well, I try to avoid the subject, but I have to admit I've been a warning to most people. I just point out, studying history, I've been doing a lot of that lately, is I think we're heading towards the biggest reset of our lifetimes. Now, you just look at property values in Florida. There is no history of major fluctuations in property values in Florida. It looks like they're just starting to roll over, what I'm hearing. And the bottom line is we're still taking away the punch bowl. And that is what I'm really worried about. It's a classic example of, look at PPI. The producer price index went from 18 to -3. That's finished goods. That's the biggest correction since 1948. So pretty significant deflationary forces. Then you look at the Fed funds at 5 1/4. It's well above in CPI, well above PPI. It's clearly contractory. And we're just early days. So I look at this as just a normal cycle. And the normal cycle is we're very elevated in risk assets, and Bitcoin is the good leading indicator, which crude oil around 40, copper lower, and I just be lucky. I mean, the problem here's the lose-lose. Every time the stock market's gone up, it's increased rate hike expectations. I don't think the Fed's going to ease until the stock market tells them to by going down.
All right.
Yeah, good stuff.
And I want to get you back on a little bit later, Mike, if we can, to talk about what's going on with the Ags, because I think it's bigger than people realize. Certainly bigger than we give it time for.
And he knows that stuff.
I know.
Yeah. All right.
That's why he's the man for that. But I don't want to waste any more time talking with Mike McGlone when we have a muni giant in the studio.
And
with
it's
us.
sponsored even, which is even better. Focus on Munis is brought to you by the... Oh, this is a bad thing. All right, the Focus on Munis, I'm going to correct it for you. I'm going to edit it on the spot. Focus on Munis is brought to you by Build America Mutual. The New Deal created American infrastructure that unleashed new opportunity. Today we're doing it again with massive investment in modernizing our infrastructure, and municipal bonds backed by Build America Mutual help make it happen. Invest in the future of America with BAM, in short, municipal bonds. How about that?
We need to actually rewrite that so there are more BAMs in it.
Yeah, well, I'll get on it. All right, Joe Misek joins us. He does all the municipal bond stuff for Bloomberg News. Joe, there's a million ways to go here. I want to go with one of my peer schools to where I went to high school, the Lawrenceville School in New Jersey. Deerfield Academy is selling bonds, municipal bonds, to refurbish its dining hall and enhance one of its traditions. Lawrenceville School is undergoing a huge build, big new field house and dining center and wellness center and all that kind of stuff. We're not going to the bond market. We're financing it with capital, equity capital, a little bit of bank capital, but that's how we're doing it. Deerfield going to the municipal bond market. Talk to us about that.
Well, this is just... Boy, that story did well in the terminal. People who are really interested in it, they're going to the bond market to sell $85 million. But here you have this very highly rated institution with apparently very loyal alums.
Of course, and a massive endowment already.
Yeah, massive endowment already, almost $800 million.
Nothing.
And
that's like a college endowment.
They get they would get.
Hang on one second. This is quick. So I actually, because last night I was talking about this with some Hotchkiss people, and they were like, "We need to build a new dining hall too, because their dining hall apparently is getting antiquated, and but it's going to cost about the same amount." Paul Sweeney brings up Lawrenceville. What's the rivalry?
There is a good rivalry between Lawrenceville and Deerfield. Good athletic rivalry. We were one of the two last all-boys boarding schools. All boys when I went there. We're now co-ed, thank goodness. But we went co-ed about the same time. So very good.
Wait, why is that a thank goodness? My boarding school also went co-ed, and I think it's a
well, it's a tale of two tapes here. Lawrenceville's transition to co-ed was extraordinarily successful for a variety of reasons. Deerfield will tell you it wasn't as good as they had hoped it to be. It's not great now, but their transition was a little bit challenging because you went, 150 years as all boys. That's a lot of tradition to kind of upend.
Yeah, I mean, I loved going to a single-sex school. I think, it kind of limited the distractions that we had.
In hindsight, it was great, but at
the time, you were like, I wish there were girls. So wait, are there any more all-boys boarding schools? Like Salisbury is all boys, right?
No more of note, I'll put it that way.
Right, because Exeter and Andover, they're both co-ed. And that's just so. But so I thought Deerfield's endowment was massive. What's the Lawrenceville endowment?
I can't remember what it is at the time, but what is financing this big, massive build on the Lawrenceville School? And if you go there, the entire campus has been torn up for a couple of years. Is Joe Tsai, my classmate.
He's
class of
that
82
helps
from Alibaba. He's been very, very supportive of the school, and that's helped.
All right, now back to munis. I found it fascinating that these private schools can sell munis. Are they going to be? Are they going to have good tax treatment and everything?
Well, sometimes they sell tax exempt, sometimes they sell taxable. It really depends on the use of the proceeds. And, they use the muni market because, they're nonprofits.
Yeah, so it's interesting.
And really, bonds like this, especially Massachusetts, because you have somewhat high taxes there, these are going to be just a blowout. Plus, it's rated AAA. Come on.
Yep. All right, talk to us about the Oscar Museum. Built by Bonds acknowledges that the writer's strike, that's a risk factor.
It is. It's funny when you go into these bond issues and you see risk factors, or sometimes they call them investment considerations, and you see something like the writer's strike come up, it's a little bit jarring because, they have to put it in there. I always tell people at the preliminary official statements and the offering documents we see are the purest manifestation of what these places have to say. So of course they say, hey, this could be a risk. We don't think so. Plus, the Oscars Museum, the Academy has, again, they have about $700 million in their investment pot. So, it's risky because they make lots of money off the annual Oscars show, but they have this big pot of cash, and they've got the museum open, and that's bringing in the visitors. Its first year of operation, they had 700,000, and looks like they're doing pretty well this year, but we'll see because they have this October 1 to October 1 year.
Matt, just to answer your question on endowments, according to Boarding School Review, Phillips Andover Academy has the largest endowment, $1.1 billion. And we go down, and Deerfield is number 4, $530 billion, and the Lawrenceville School is 6, $459 million. So some big numbers out there, but they still need the municipal market, as Joe was just pointing out. Hey, Joe, guess what?
That's it?
That's it.
No,
that
wait,
is
no.
it for municipal bonds, and there's a lot to get to. We didn't even get to Hawaii Electric. We'll do that next week because they got some municipal bonds outstanding. We want to get a sense of what's happening out there. Joe Misek joining us for his weekly spot, talking about municipal bonds. Joe is the editor of Bloomberg Brief, focusing on the municipal bonds. S&P 500 pretty much unched on the day. We'll call that same for the Dow. NASDAQ, a little bit of red on the screen, off about 0.4%. So we are off the intraday lows of the day. We'll see how we can trade them in this afternoon. Well, more coming up. This is Bloomberg. Company news with Lisa Mateo.
Paul, Goldman Sachs is planning a hiring spree. Sources tell Bloomberg the Wall Street firm is bringing on several hundred new staffers to help address concerns from authorities, including the Federal Reserve. Meanwhile, layoffs, they're coming to a major media company. Bloomberg's Kimberly Adams has the story.
Warner Brothers Discovery continues to cut its workforce. Variety reporting the latest round of layoffs hit the marketing team at HBO and Max. The number of cuts is said to be in the double digits.
Now, shares of Warner Brothers Discovery right now down about 0.3%. And WeWork is making a move to save its listing on the New York Stock Exchange. The troubled co-working company on the brink of collapse, it's moving forward with a 1-for-40 reverse stock split. Now, it goes into effect after the closing bell on September 1st. Shares of WeWork right now down about 17%. And Americans are willing to pay higher prices for drugs to help them lose weight. Bloomberg's Steve Potisk has more.
Next-generation weight loss drugs having all the rage lately, but they don't come cheap. And in the U.S., that's truer than the rest of the world. According to a study from the Kaiser Family Foundation and Peterson Center on Healthcare, the drugs can cost 5 times as much or more in the U.S. than they do anywhere else in the world.
All right, so just to give you an idea of how much more Americans are paying, a 1-month supply of Novo Nordisk pricey Wegovy, it's going to run you about $1,349 in the U.S., but in Germany, it's going to cost you just $328 for the same supply. Now, just a quarter of private insurance plans cover those drugs. They're not even covered by Medicare. Shares of Novo Nordisk right now down just a fraction. I'm Lisa Mateo. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com. On Bloomberg Television and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:21 on Wall Street. I'm Denise Pellegrini. We check the markets for you all day long at Bloomberg Stocks. They're now mixed. The Dow is actually squeezing out a tiny gain, up fractionally, up 30 points now after being lower most of the morning. The S&P 500, though, it's still lower by about 0.1%. And the NASDAQ, it is also lower, down about 0.5%, down about 72 points right now. The yield on the 10-year right now, 4.2%. Spot gold, it's up about 0.2% at $18.93 an ounce. NYMEX crude right now, it's up about 0.1% at $80.47 a barrel. Deere lower even after boosting its annual forecast. Estee Lauder profit outlook for the fiscal year below estimates. Some worries out there about weaker than expected retail travel business in Asia. That stock's been a little bit lower for much of the morning. And Ford debuting its 2025 Mustang GTD. This features a supercharged V8 engine. They're calling it the highest horsepower Mustang ever developed by Ford, at least among those that are street legal.
Oh, yeah.
And the limited edition coupe, it has a exterior made almost entirely of carbon fiber. It'll cost you about $300,000, Matt. And I don't know. My dad was a race car driver. He never raced down what he called civilian streets. So I don't know why people want that.
Well, maybe they're bringing street racing back, you know? Like the days when you used to play chicken.
Play chicken, yeah. James Dean.
All right, Denise. Thank you so much, Denise Pellegrini. There giving us.
I'm excited about
update.
that car. It's got the 5.2 liter cross plane V8, which
the cross plane V8,
which sounds like
that's interesting.
A Ferrari, you know. But it's going to be a boosted version of what they have in like the Shelby GT 500, so over 800 horsepower.
Nice. You still don't have your Scat Pack thing, Challenger.
No, you know what? I sent an email to my buddy at Dodge yesterday and said, dude, like, when is this car gonna come? Because I've got a road trip coming up. You know, I'm taking my daughter back to Ohio for a family reunion, and I don't want to roll up in a big muscle car.
Yeah. They'd love that.
Otherwise, I'm gonna have to fly, and what a pain that is.
Yeah, you don't fun. All right. Yeah, you know some people there. Make some phone calls there. All right, let's check in with this market here. We've got the S&P 500 down about 5% from its recent highs. The question for a lot of folks is, just a healthy pullback in an otherwise upward moving market, or is there something bigger going on here? Is maybe the market discounts higher for longer? David Kudla, founder, CEO, and CIO of Mainstay Capital Management, joins us. So, David, what say you here as we think about just the last few weeks of trading here? A little bit of a pullback in this market. How do you view that?
Yeah, good morning, Matt. I think we got maybe a little bit extended in July, and we had a 5% pullback earlier this year with issues with the banks. This one is, with yields rising, maybe China also is a little bit of the catalyst for another pullback. Right now, 5%, probably a little bit further to go. But these are to be expected. We get a couple of these a year, and we're still constructive on stocks. We are concerned about where yields are going when we look at how resilient this economy is, with the GDP now forecast from the Atlanta Fed of 5.8%. We've got housing rebounding. We've got manufacturing is starting to lift off, and some other positive economic data. And of course, labor remains tight. So there's this. There was a thought that the Fed would start cutting rates later this year. There's a lot of analyst strategists that thinks they'll still cut in the beginning of next year, but that would be because of economic weakness. And the question is, will we get that?
So it looks like we're continuing to get economic strength, and I guess that's what's driven the rally thus far. We had also expected kind of a broadening out of the gains, right? Because it was all at the beginning of the year, the Magnificent Seven, as they've been dubbed, which is, by the way, I think it's a horrible moniker. We've got to think of something better than that. But do you expect the rest of the stock market to catch up with the gains that we've seen in tech, especially as tech now starting to give some of those up?
Yeah, and we've seen that start to happen, and it's really come from both ends, right? We've seen the Magnificent Seven, some of those stocks or some of those mega cap tech stocks correct even more, quite a bit more than the broader market in this correction. but also as far back as June, we started to see the market start to broaden into mid caps and small caps finally, and also value and cyclicals. So we were heavy into growth in the first half of the year, and we started broadening into some mid cap and small cap exposure and value and cyclicals, and doing that by reducing, for instance, our exposure in Europe, which had done very good in the first part of the year, but we've got concerns about overseas markets. Certainly, the strongest major economy around the globe right now is right here in the United States.
All right, you talk about around the globe here. I guess in the last couple of weeks, David, we've got some economic data coming out of China that's a little disconcerting, certainly for the Chinese, but also maybe for global investors here. How do you think that affects maybe your portfolio, your view of the market?
Yeah, well, I've heard this term recently, and this might be a variation on it, that China is an economic whale, but a financial markets minnow. So it's right. So it's a question of how much impact does it have on the financial markets. But if we look at the economy of China, we look at how much that affects Europe. The major exporter of Germany is to China. And so as much as trade in their economy can affect other economies around the world, that affects those markets. But we had the second largest real estate developer, Evergrande, which has been in trouble. We've talked about it a long time, which filed for Chapter 15 bankruptcy here, and just a lot of problems in China that the story continues to worsen. And I don't think that it just can't not have an impact on other markets to some degree, even if it's from an overall weighting perspective. We just don't see it as that great compared to other developed markets.
Yeah, it does seem that, we sort of knew or had some inkling recently that the China recovery wasn't on, but now it looks like it's getting worse and worse. And, how much can that drag us down if they really start to have a lot more defaults, a real loss of confidence, and a weakening currency?
Yeah, it's certainly much more of it has much more of an impact regionally, right, on emerging market countries that depend a lot on China. So EM in that area, which we've been reducing our exposure to as well. But in terms of the U.S., we're more concerned about where yields go from here. With what we've seen yields do just in the past month here. And how the Fed, what their path will be going forward. I think that's really more important for our markets, both stocks and bonds. As we've seen, the 10-year yield at a 15-year high. The aggregate bond index yesterday finished with a negative year-to-date close yesterday. It's back up again today, but really the only place it's safe, the place that we've been in since the beginning of the year, is the shortest end of the curve, ultra short-term duration. And that's been, those bonds are up 4, 5, 6% year to date, and floating rate. So a 60-40 portfolio has worked well this year if you've held your 40% income in ultra short duration floating rate. If you're out on the long end of the curve, or even the intermediate term of the curve at this point, you've gotten hurt pretty bad in the income portion of your portfolio.
So, David, it seems like the narrative, even in the marketplace, has kind of shifted a little bit over the past couple of weeks about what the Fed will do to rates in 2024. I think if you look at the WIRP function, markets were really looking for aggressive rate cuts next year. Now, not so much. Are we going to see any rate cuts next year?
Everyone thought we would see rate cuts next year. Many strategists 6, 8, 9 months ago thought we'd be in a recession right now. those rate cuts would have been in the back half of this year. I have a phrase that I've used: the recession that's always 6 months away,
right?
But it never gets here. And with the the data coming in and especially these GDP numbers, it's just hard to see when that's gonna happen, when that's gonna materialize. And there is some negative economic data. We're seeing what's happened with credit card interest rates, which could affect consumer spending, default rates, things like that. But we would have to have, why would they cut rates? They would cut rates on economic weakness or on that recession. And when do we expect that to happen? Many don't see a recession as likely, but are still calling for rate cuts next year. And those two don't match up.
No, they don't. Yep. It seems at this point more likely that we see a hike.
That's
another hike.
Yeah, and there's there's talk about maybe not a hike at this next meeting, but the meeting after. So the opposite of what was thought several months ago.
Yeah. I'm not buying that.
We're
I'm
more likely to.
I'm being more optimistic, David, than the average bear out there and Matt Miller. David Kudlow, thanks so much for joining us. As always, love getting your thoughts on the markets. David Kudlow is a founder, CEO, and CIO of Mainstay Capital Management. I don't think we need that talk of.
But in a way, dude, in a way, it is optimistic, right? Because
that means
we had people forecasting only 0.5% growth this quarter, and now we're looking at forecasts, I think 1.8%.
Yep.
So as the economy gets stronger and stronger, obviously that's a tailwind for inflation. But if we get growth, nominal growth, then that's okay too.
I need nominal wage growth to offset my high mortgage thing, or I have to refinance my mortgage.
I'll put in a good word for you.
Okay, thank you.
At review time.
Carries a lot of weight. Let's get our news right now in New York City. Michael Barr.
Well, Matt, thank you very much. 11:33 on Wall Street. Right now, President Biden's trilateral summit with the leaders of Japan and South Korea is underway at Camp David. The focus of today's meetings will largely involve the threats posed by China and North Korea. National Security Advisor Jake Sullivan says the U.S. remains concerned with the ongoing relationship between Russia and North Korea, including intelligence that suggests Pyongyang is supplying Moscow with new missiles and weapons in the war against Ukraine.
As we have seen, Russia has been seeking to get materiel for its war effort in Ukraine from Pyongyang, from North Korea. And as they have done with other countries like Iran, when they ask, they usually also offer some types of security cooperation in return. So that's something that we're taking a hard look at.
Other likely topics will include economics, technology, and public health. Several 2024 GOP presidential candidates traveled to Atlanta, Georgia today to address voters after former President Donald Trump was indicted by Fulton County prosecutors. Senator Tim Scott.
I am living proof that the American dream is alive and it is well. And that no matter where you start in this country, if you work hard, work on your character, have strong grit, all things are possible.
Senator Scott went on to say that conservatism works. Recovery crews with cadaver dogs in Maui continue to comb through the devastated Hawaiian island of Lahaina. At least 111 are known dead from the wildfires and about 1,000 unaccounted for. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:40 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks are lower once again. Bitcoin, it is down just about 5%, almost 6% actually right now, at about 26,044. As for stocks, Michael Hartnett, strategist at B of A, he is calling for a 4% drop in the S&P from here. And we also heard from Ed Yardeni, President Yardeni Research. He says the recent rise in bond yields, well, that is pouring cold water on his previous bullish call for stocks, at least in the short term.
Well, look, I thought we would end up the year at 4,600 on the S&P 500. We got there at the end of July, and I decided not to raise my forecast. So I'm looking for the market to either move sideways or continue with this pullback, maybe even down to the 200-day moving average, and concerns about what the bond markets, bond vigilantes are going to do. But then I think by year end, we'll still end up around 4,600. Next year, I'm looking for 5,400, but I think in the short term here, it's why the market has been down since really the end of July.
4,600 would be quite a gain, what Yardeni is talking about there. Right now, the S&P 500 is 43.54, down about 0.3% on the day, down 15 points. The Dow down fractionally, down 15 points. The NASDAQ down 0.8%, that's about 110 points lower. The yield on the 10-year right now, 4.229%. Spot gold, it's up about 0.1%, $18.90 an ounce. NYMEX crude up about 0.3% at $80.61 a barrel now. Deer lower, that's even after boosting its results, but it is off session lows, down only about 3% or so now. And how do you like to hop on a Peloton bike on a break? Paul, this is kind of a question for you.
Sure.
They're trying to reinvent themselves. You know, not as many people doing that home thing anymore because post-pandemic, right? So they're pitching now to companies, could we have a Peloton at work and maybe offer it as a perk? I don't know. I tried to pitch something like that at Bloomberg, where we would have treadmills that would actually power the Bloomberg terminals that we have out there in the lobby. I thought it was such a cool idea and so Bloomberg-esque, right? Human-powered, everything.
Yeah.
That thing got nixed so fast. So many employees jumped right in on our message board, and they were like, Denise, we have to have showers if we exercise at work in the company. I mean, the showers, it's not our thing here.
I once pitched a shark. You know, we have so many fish, and people who've never been to a Bloomberg office, there are fish everywhere in every office. And I said, why don't we, at least at the headquarters, have like a big shark?
Oh, I love that.
Yeah. How'd that go?
No, didn't happen.
All right.
Because we have sharks on Wall Street, too, so
We do.
people would like that.
Very good. Denise Pellegrini, thank you so much. We appreciate that. You know, Matt, when we talk about the economy, oftentimes folks will say, you know, I'm thinking about a hard landing, I'm thinking about a soft landing. And then we've recently heard this phrase, no landing. And I think we need to talk to a licensed pilot because I don't think that's even possible. Fortunate for us, our next guest is a licensed pilot, Jamie Patton. She's co-head of global rates at TCW. So Jamie, got a lot of smart people there at TCW out in Los Angeles. What kind of economic landing are you guys calling for?
Well, thank you for bringing up the no landing scenario analogy, which is my least favorite analogy of all time. Mostly because it defies the laws of physics. What goes up must come down. But also just being a pilot, airplanes run on gas. And even if everything goes perfectly and you really don't want to land, you're going to run out of gas. So I hate that analogy. But I do love flying analogies. And I think that they're perfect for monetary policy hiking cycles, especially this one. At TCW, we are expecting a hard landing. Specifically, the analogy that I like the most is a soft field landing, which, to give you a little bit of background, not to talk about flying too much.
Let's do it.
Soft field landings are notoriously dangerous. Pilots never totally know what hazards lurk under the surface of a soft field landing. So a soft field landing is off airport. It could be grass, gravel, sand, snow.
The Hudson River.
Exactly. So there could be wildlife wandering around. There's barbed wire fences. difficult to see from the air. A regional banking crisis might be brewing under the surface of a robust economy. And as we're coming in for this landing, we are not expecting it to be soft for a lot of reasons that I can get into. But we also see so many hazards, and just the chances that the economy has a soft landing with a hiking cycle that's been the most aggressive in 40 years, we just find to be very unlikely.
You know, I heard a great analogy this morning on Surveillance from Laura Rame. She said that the economy is like an 18-wheeler. And before the great financial crisis, when a lot of people still had fixed rate mortgages or floating rate mortgages, the Fed could pull on the brake lever and that would slow down like 10 wheels. So it could bring, the economy to a stop relatively quickly. But now that everyone has shifted to fixed rate mortgages, the brake lever only affects like 3 or 4 wheels, and it's much harder to slow this truck down. Does that make more sense?
Absolutely. So the way that we talk about this is the interest rate sensitivity of the U.S. economy. And specifically, we've heard a lot of Fed speakers talk about this recently in the form of monetary policy lags. So we know they're long, we know they're variable, we know it takes time for an adjustment in monetary policy, such as the Fed hiking rates, to feed its way through the macro economy. But we don't know how long. And recently, these Fed speakers, especially Waller last month, has said the lag should be shorter now because we have forward guidance that feeds into rates markets instantly, and the size of the shock will make the lag shorter. We very much disagree with this. We think that lags are likely to be longer today, not just the mortgage argument is a really good one. It's an $8 trillion agency MBS market, and less than 1% now is adjustable rate. Prior to the global financial crisis, it was 12 to 20 times that. There are also other reasons that make our economy today less rate sensitive. One is the Fed's $8 trillion balance sheet cushioning the bloat of financial markets. It was $1 trillion prior to the global financial crisis. And also some psychological impacts where the economy really has changed in some ways post-COVID. One thing that we talk about here is labor hoarding. If a company had really struggled to get labor during COVID, prior to COVID, they're also really hesitant to lay off that labor or reduce that labor today. And it's harder to see that in economic data, but one thing you could look at is something like overtime hours, specifically in manufacturing. It's the lowest we've ever seen outside of recessionary times. So what does that tell us? Well, we don't really need this labor, but we're going to keep it around. So maybe we just have them working less and less. And then you might ask, well, why does that all matter? Not just because we need to know when these interest rate hikes are going to impact the economy, but if the Fed thinks that the interest rate impacts are going to impact the economy sooner, and we think that's not true, that means the Fed is very likely to keep rates too high for too long, over tighten, and that would raise the risk of a larger than expected decline in growth and eventually inflation. It supports our long duration position. I also think that's why this no landing scenario gets spread around, where people are just expecting the lag to be short. It's actually long. They think everything is great, but we see it coming crashing down pretty hard just in more like a year instead of 3 months.
Man, you guys are brutal out there in LA. I mean, I know you got writer strikes and actor strikes, but man, that's a dour outlook.
Not just brutal, a big deal. A massive attraction. If you're doing a tour around the country, you stop at TCW?
Oh, that's you build around TCW and Capital Group, and everything else falls into place. All right, so are we going to get any rate cuts next year, Jamie?
We do think the Fed will cut rates next year. The market has the Fed cutting rates about halfway through the year. The Fed itself has the Fed cutting rates about 100 basis points next year. We agree. We think that the Fed will wait to cut rates until they are very confident that inflation is heading back down towards their 2% target. And even though they're probably really happy with the progress they've seen in the June and July inflation prints, they still have a ways to go. The last two prints for consumer prices, CPI was 3% and 3.2%. That's 1/3 of what inflation was last summer and 1/2 of what it was even at the beginning of the year. But it still has a ways to go. The Fed's own forecast of core PCE is still 3.9% at the end of the year. So that's really far above their 2% target still.
All right. Jamie Patton, that was excellent stuff. We're going to have you back, whether you like it or not. Jamie Patton, co-head of global rates at TCW. not a soft landing kind of person, definitely not a no landing kind of person, kind of suggesting there's a harder landing on the horizon for this U.S. economy. S&P 500 down 0.2%. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Actress Jessica Alba's baby and beauty product company is coming to the country's biggest retailer. Bloomberg's Gina Cervetti reports.
Honest will start rolling out its baby wipes, shampoos, and body washes at Walmart stores. Its diapers are already available in about half of Walmart locations. A source tells Bloomberg that Honest also plans to sell its baby clothes at Walmart this fall. Honest is trying to revive growth after a slump last year.
Well, shares right now of Honest are down about 1.5%. Some legal troubles are brewing for a few clothing retailers. Bloomberg's Steve Rappaport has that story.
Lisa, a few J.Crew customers are suing the fashion brand, accusing it of forcing them to turn over contact information during in-store checkout and using it for marketing purposes. Meanwhile, Gap faces a proposed class action in New Hampshire, accusing the retailer of sending customers' driver's license information to a third party without their permission.
And Gap shares right now, they're up about 1%. And one of the world's largest beauty companies, Coty, is renewing its license with Adidas. Terms of the deal were not disclosed. Now, on a side note, Women's Wear Daily reports Coty may be in talks with Kim Kardashian to sell back her beauty brand. Shares of Coty right now, they are up about 1%. Shares of Adidas down just a fraction. And influencers like Kim Kardashian get paid big bucks from companies to post content about their brands. Well, Amazon, they are trying to get content creators to post videos to improve its shopping feed. But it's making lowball offers, and it's getting blasted on social media now. Amazon said it's going to pay $25 per video. Most content creators charge about $200 or more. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at this market, the S&P 500 remains kind of unchanged. I'll say the same for the Dow. NASDAQ off about 0.4%. Treasury market, a 10-year off 4 basis points to 4.23%. The 2 years at 4.9%, off 2 basis points. WTI crude oil pretty steady here, just about $80.64. We will keep an eye on that. Bitcoin off 6.1%. Below $26,000 or $25,969. So a real breakdown short term there in that crypto space.
That's a move.
That is a move, absolutely.
I mean, that was swift, right? We were just hovering at $30,000 for 2 months.
Forever, exactly.
And then boom.
Yep.
You lost $5,000.
I guess Tom Keene heading for the exits. You know, that's been known to happen. All right, let's get some news in New York City with Michael Barr.
Paul, Matt, thank you very much. It's 11:56 on Wall Street. Many hope history is made at Camp David.
Welcome.
President Biden is meeting right now with the leaders of South Korea and Japan. The White House says today's summit will open a new era in the trilateral partnership. South Korea and Japan are putting aside decades of strained relationships to deal with mutual threats, China and North Korea. National Security Advisor Jake Sullivan spoke about the summit today during a news conference at Camp David.
This is a big deal. It is a historic event, and it sets the conditions for a more peaceful and prosperous Indo-Pacific.
The gathering also marks many firsts, including the first time President Biden is hosting world leaders at the storied Maryland retreat. It is a grim number concerning troop deaths and injuries in the war between Ukraine and Russia. U.S. officials say the total number of Ukrainian and Russian troops killed or wounded since the war in Ukraine began 18 months ago is nearing 500,000. Hurricane Hillary has grown rapidly to a Category 4 strength off Mexico's Pacific coast and could reach Southern California as the first tropical storm there in 84 years. The National Hurricane Center said Hillary has sustained winds near 145 miles per hour. Several prominent Republican conservatives, including a number of 2024 GOP nominees, traveled to Atlanta today for the gathering, a conservative political conference. It comes after former President Donald Trump was indicted by Fulton County prosecutors for alleged efforts to overturn the 2020 election results in the state. While speaking at the event, Georgia Governor Brian Kemp asserts that he still believes the 2020 election was not stolen in Georgia.
During the whole 2020 election, there was a lot of things said, a lot of things done. At the end of the day, I followed the law and the Constitution.
Governor Kemp also says despite what date anybody's asking for about the trial, it's not going to happen before the election. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt.
All right, Michael Barr, thank you so much. We appreciate that. Well, Matt, our last guest from TCW was talking about a hard landing, but they are not seeing a hard landing down at the University of Alabama. Students there are spending $20,000 on Rolex and Cartier for Rush season. About 2,500 young women are currently participating in sorority Rush recruitment at the University of Alabama. It's all over TikTok. They're spending big money on watches and outfits of the day. I don't know.
I mean,
I know it's big down there.
Watches cost a lot of money. If you're gonna throw a Rolex on your wrist, that's gonna cost $10,000 to $20,000, no matter what else you're wearing.
Why are you doing this to get into a sorority or fraternity?
No, it seems pretty silly to me. But they've been doing this kind of thing for years. I remember when I was a kid. I grew up in Granville, Ohio, where Denison University is located. Yep. And sorority rush there was insane back then. Now it's worse these days because social media has made pretty much everything worse, right? But
parents, here, according to New York Post, parents drop thousands on recruitment coaches to ensure daughters' success in sorority rush.
So sad.
According to the Wall Street Journal, sorority consultants help women dress to impress during rush. So that's the Greek life, a lot of these big schools, southern schools, it is big. And boy, they're spending money on it.
Just sounds pathetic to me.
Sounds kind of weak to me, but we'll see. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour in our C-Suite conversation, we're going to talk to Charles Gillespie, CEO of Gambling.com. Gee, I wonder what they do. We're going to discuss the company's earnings and maybe that Penn Entertainment, ESPN deal and just kind of what's happening in the sports gaming business. And then, boom, a new segment. What is Matt Miller driving? Matt talks about the latest car he's driving this week with Kyle Stock, senior correspondent with Bloomberg Business Week. So
and you
and me, but
I'll tell you what,
you guys
I'm driving an Audi Q8 e-tron.
Q8 e-tron.
So it's in Audi's biggest SUV powered solely by batteries.
And well, we'll get to it.
Yeah, I'll give you my verdict later.
That's coming up. All right, we got a lot of stuff coming up, but let's kick it off with Charlie Pellet. He'll get us going.
Thank you very much. We got the Dow driving higher right now, higher by 50 points, up by about 0.1%. S&P was positive just a moment ago, up by 1 point. Right now, though, looking at a loss, swinging between gains and losses now on the S&P, down by 0.5 point. Little change. That is the key takeaway on this Friday. We've got NASDAQ down 38, drop there of just about 0.3%, on track for a losing week. And we've got the 10-year at 4.22%. The 2-year now 4.90%. Spot gold up $2.50 the ounce to $18.91. That is a gain of 0.1%. West Texas Intermediate crude up 0.2%, $80.58 a barrel on West Texas Intermediate crude. Certainly, Bitcoin getting a lot of attention today. Bitcoin down 6%, below 26,000, as we mentioned, at 25,987 right now on Bitcoin. So U.S. stocks trading mixed with both the Dow and now the S&P higher, NASDAQ lower. As for the overall market backdrop, specifically rising yields, Michael O'Rourke is Chief Market Strategist at Jones Trading Institutional, and he was our guest right here on Bloomberg Markets.
It all seemed to be tipped off with the Fitch downgraded earlier at the beginning of the month. And I think the market has realized there's something to this, that we have all this deficit spending and that that we are looking at a higher interest rate environment going, for a longer period of time. And I think that's just starting to get repriced in now.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Deere & Company shares are slipping as investors question how much longer the boom in sales of tractors and other farm machinery can last amid slumping crop prices. Deere shares, they're down for a fourth day right now, dropping by 4.1% after earnings. So again, recapping, we are looking at a mixed day on Wall Street. S&P 500 index now higher by a point, little change there. The Dow up 0.2%, NASDAQ down 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We're also live on YouTube, so just head over there and search Bloomberg Radio. Hey, Matt, remember, 6 months ago, 12 months ago, we interviewed Vivek Ramaswamy.
Yeah.
At the time he came in, he was talking about a new ETF he had, DRIL, Drill.
Yeah, it's Strive, the Strive asset management company that he runs.
Exactly. Well, he's running for president. Do you know that? He's getting a lot of traction, too, but he's also got some legal challenges coming his way. GOP presidential hopeful Ramaswamy sued over Strive's practices. That's a Bloomberg Business Week article written by Max Chafkin. A scoop, big time. Max Chafkin joins us. Max, talk to us about Mr. Ramaswamy and what may be some of his legal challenges.
Right. So, as you said, Vivek Ramaswamy, entrepreneur, started a drug development company called Roivant before this firm, Strive. He started Strive in 2022. it had a sort of political valence from the beginning. You know, Ramaswamy is kind of an activist, conservative activist. He wrote the book Woke Inc. And Strive sort of framed its approach as anti-ESG. Like they were going to, zig the opposite way that many on Wall Street.
Just to be clear,
zagging.
Max, when he comes on Bloomberg Radio, he says specifically that he's not anti-ESG.
Yeah, I mean, it's very confusing, and the messaging has changed from time to time. Yeah. Sure, he certainly criticizes ESG a lot, and earlier this year or at the end of last year, Strive, had engaged in a whole proxy campaign with a bunch of big companies, pushing back on various ESG things. So you can kind of talk about it however you want, but it had a political valence. Ramaswamy then ran for president, announced earlier this year. And Strive has it's been a little bit up and down. Some of that I think has to do with the market. But what the latest thing that just happened is we've seen two former employees sue. They are both, the lawsuits are different, but they're both alleging that they were pressured to violate securities laws, that there was pressure to grow the company quickly, and that there was pressure put on from Vivek Ramaswamy, his co-founder, Anson Frericks, to essentially, have employees pitch securities when they weren't registered, sending out, unapproved sales materials, that sort of thing. This is significant, partly, obviously partly because Strive is kind of this, upstart asset manager, is trying to, bring in more business, but also, of course, because Ramaswamy is going to debate Ron DeSantis and the other GOP presidential candidates, perhaps minus Trump. And, DeSantis and others have sort of signaled that they're going to be bringing up some of this business stuff. So it kind of, it raises, I suppose, some questions about his business practices and could end up having, I suppose, political implications, especially at a time when Ramaswamy's campaign has seemed to really be taking off. He's been moving up in the polls pretty consistently over the past few months.
So this is, I guess, a civil suit then brought by former employees. Doesn't the SEC step in as well if it's true, their allegations are true, that he broke securities laws?
Yeah, I mean, I think that's possible. I mean, what we have are these two civil cases, separate civil cases brought in different state courts. I mean, this is all kind of like breaking news. In both cases, Strive hasn't responded to these complaints legally. They gave me a comment that essentially says that they plan that they're going to fight this, but nothing beyond that. And so we don't yet know how this is all going to shake out. I think it's this is kind of there are some serious allegations in these lawsuits. One of them alleges fraud. The other one alleges that senior Strive executives kind of like looked the other way on sexual harassment complaints. I think this is kind of
those are wildly
the type
different
of
allegations, right? I mean,
yes.
Is it about securities fraud or
Right. Well, it's about both. Like as I said, so one of the employees is alleging she was retaliated against for raising a bunch of concerns, including securities fraud and sexual harassment. The securities fraud thing, alleged securities law breaches, comes up in both lawsuits. Strive is a startup, and you see these kinds of things in startups that are attempting to grow quickly. But again, Vivek Ramaswamy is running for president, and Strive is operating in a highly regulated industry. So I mean, it's definitely worth watching.
Hey, Max, has Mr. Ramaswamy or his camp or anybody kind of responded to any of these issues over the last several days, or just in terms of questioning the company?
So, I mean, in terms of these suits, no. I mean, Ramaswamy's campaign manager, just before we published the story, told me that they were not planning on commenting on it, although she told me that Ramaswamy is separate from the company. Ramaswamy left the company. These lawsuits are certainly mostly related to Strive and are relevant in terms of his background, but don't have anything to do with the presidential campaign in a sort of precise way, I suppose.
What is his strategy in terms of the campaign? Because I noticed when Trump was being indicted in Miami, Ramaswamy went down there to the courthouse and set up a kind of like an I Love Donald Trump stand, which is weird because
we're introducing
you would think they were
access
competitors.
to the YouTube Partner Program.
Ramaswamy, I mean, he's run a very successful campaign thus far, going with, almost no name recognition. I mean, he had a best-selling book, but even so, when if you talk to like regular Republican voters, most of them, had no idea who he was until a couple of months ago. And what he's done essentially is run as a kind of like Trump surrogate, which is weird because, as you say, he is running against Donald Trump. But the state of play, in the Republican Party is that if you look at the polls, like Trump is far and away in the lead. You're talking about, depending on which poll you look at, between 40 and something like, mid 50%. And so running in such a way where you're saying, well, if I'm not going to criticize Donald Trump directly, he's a great president and so on. That's kind of how Ramaswamy puts it. And I think most of his supporters look at him as kind of like a backup plan, right? As somebody who, would really, if the most committed supporters probably would like to see him as the vice president. And maybe other people see him as somebody who would be a nice person to have on the ballot if their number one candidate Donald Trump doesn't run for president. I also think he has an interesting story. He has an impressive background. As I said, he's been very successful in business, notwithstanding these lawsuits. He's an incredibly charismatic guy, and has brought an approach to politics that, while extremely far right, I mean, he's running, I'd say, as far to the right of Trump, but is right. I think has had success in relating to voters, and he's a very good communicator. You watch these speeches, and they're compelling, and I think people are responding to that.
Ton of inflows too. I just look at his ETFs, and there's almost $500 million in inflows this year.
This year? Oh, yeah. Nice. All right, good for him. All right, Max, thanks so much for joining us. Great reporting there. Max Chafkin, columnist for Bloomberg Business Week. Check out the story on the terminal and Bloomberg.com at some point. All right, let's pivot. Let's get to a C-suite conversation today. Let's talk gaming. That's just a way of saying the casino business, which I love. Charles Gillespie, CEO of Gambling.com, joins us. Charles, thanks so much for joining us here. Gambling.com, tell us about this company. What are you guys up to?
Thanks, guys. Great to be here. So Gambling.com Group publishes essentially online comparison shopping websites for the global online gambling industry. So, if you're going to go to Paris, for example, and you need to book a hotel, you're probably going to go to hotels.com or Expedia or something like that, get all the information there in one place, and then book your hotel. We essentially do the same thing, but for online gambling. So if you want to bet on sports and you're in New York or New Jersey or one of the other 25 states where you can bet on sports legally in the United States, you come to gambling.com or one of our 50 other websites. We also have bookies.com, casinos.com. We also own rotowire.com. And we'll give you all that information, help you find the best sports book or online casino for whatever your needs are.
Are you comparing the odds? Who's going to offer me the best odds? Or what are you actually measuring?
We do that, yeah. So bookies.com has got odds comparison and tons of data about sports, but a lot of users, they don't even need that level of information. They just want to know, okay, in, Pennsylvania, what sports books are even available? Which ones are legal? And, of the ones that are legal, well, which ones have the best sign-up offers? Which ones have the best customer service? Which ones will pay me quickly if I win? So in many cases, it's just kind of, frankly, more basic things that move the needle for individual users that we supply. But yeah, for the sophisticated users, we've got odds comparison and all kinds of great stuff.
Now, Charles, it's kind of a controversial business. Obviously, if you're an adult, you should probably be able to make your own decisions about what you do with your money. And if it were illegal, everybody would be doing it underground anyway. But did you have any reservations with using such blunt brand names? Gambling.com and bookies.com is something that I don't think my mom would want me messing around with.
Absolutely not. I mean, to borrow a British saying, they do what it says on the tin. It's very clear. It's good branding. obviously I'm an industry guy. I've been doing this for 17 years, so I've been drinking the Kool-Aid for a long time. But I don't think that the industry is controversial at all. When you zoom out and look at it from you look at the whole kind of thing in its entirety. What I think is controversial is states that haven't regulated online gambling, because it's not like online gambling isn't happening in these states. You said it yourself, Matt. All these people are playing online regardless. It's just a question of whether they're at the regulated sites or if they're at the Costa Rican and Panama-based sites. And you can't help the problem gamblers if they're not within the regulated ecosystem, because you don't know anything about them. So it's clearly a net positive for every jurisdiction that regulates the industry, because they get so many more tools to actually help people that need help. And that is the real thing that we should all be doing, is trying to do what we can to minimize gambling related harm. And that obviously starts with a regulated market.
How important was it for the industry, Charles, for ESPN to ink their deal? I think, was it with Penn? I forget, was it with Penn? But just to ink their deal, to really kind of jump into the deep end of the pool with their deal with Penn Entertainment.
Yeah, I'm not sure they're in the deep end of the pool. I'd say they're in the shallow end, or the kiddie pool. They're not actually the ones taking the bets. And what they've done with Penn is they've licensed the ESPN name to Penn, but Penn is the regulated gambling operator with all the licenses that's going to do the heavy lifting. But it is a very big deal. This American sports betting renaissance started in 2018 with the Supreme Court decision, and ever since that moment, all eyes have been on ESPN, and there's been tons of speculation about what they may actually do. Disney's, obviously had a very kind of conservative approach to the whole thing. They don't want to be seen to be in the gambling business. They certainly don't want to have anything to do with online casino. And it took 5 years, but they finally done a deal. It's a relatively simple deal where they license their brand to Penn, and as I said, Penn will operate it. There's other chess pieces that got moved around when Penn announced that deal. They had previously acquired Barstool, which is a fascinating media organization, and
talk about controversial.
I think that,
David Portnoy and Barstool.
There's plenty of things have been said about Barstool, and I don't want to wade into that conversation. But just from a pure media perspective, I mean, they have incredible engagement, and a lot of the content is highly compelling. It is a fascinating business. Agreed. And in the end, Penn, I think realized maybe that's not the best fit for a regulated gambling company. Obviously not everybody agrees with everything that Portnoy says. And, I think certain gaming regulators in the end were just not totally comfortable. Right. And Penn needed to essentially replace that partner. And that's what they've done. And Dave Portnoy at the end of this has come out looking like an absolute legend, having sold Barstool for, an actual proper fortune, and then now having bought it back for $1.
Exactly.
It's the stuff of
it's fun to follow. That's for sure. Charles Gillespie, thanks so much for joining us. Charles Gillespie is the CEO of Gambling.com. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Deere has raised its annual profit outlook, saying that demand remains strong. But shares right now, they're in the red. Bloomberg's Abigail Doolittle explains why.
Oppenheimer is saying that guidance from Deere implies a more muted fourth quarter, and this has to do with some analysts thinking that we've seen peak agriculture, that the best is really kind of here for Deere in terms of the Russia-Ukraine war, that sent crop tire and U.S. farmers scrambling to buy their machinery.
Now, shares of Deere right now, they are down about 4%. And Honda has unveiled two new fully electric SUVs under its Acura brand, the ZDX and the ZDX Type S. They're set to go on sale in the U.S. early next year. Bloomberg's global auto editor, Craig Trudell, says both models will have General Motors underpinning.
Honda and General Motors have had an agreement for some time now to collaborate on electric vehicles and basically share the underpinnings. to sort of spread the cost and sort of build economies of scale that they wouldn't otherwise have if they weren't working together.
Now, Trudell says underpinning becoming more common among car companies as they switch to electric vehicles. Shares of Honda right now, they are down about 0.3%. And this one has Matt Miller written all over it. Ford debuted its 2025 Mustang GTD. It has a supercharged V8 engine, the highest horsepower street-legal Mustang ever developed by Ford. Maybe a little too dangerous for Matt. And get this, its exterior made almost entirely of carbon fiber. The price tag, $300,000. Shares of Ford right now up about 8
Just too expensive.
It's crazy.
It's not too fast for me. It's just too expensive.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow higher, S&P, NASDAQ, they are both in the red. However, stocks have clawed back some of the week's losses driven by fears of higher global interest rates. Right now, the S&P is down 5, swinging between gains and losses. We're looking at a loss right now of just about 0.1%. Dow Industrials, they are higher. The Dow up 34 points. That is a gain of about 0.1%. NASDAQ, the 100 index, down 52 points. Dropped there of just about 0.4%, while the composite index is down 48 points, a decline now of 0.4%. 10-year yield 4.22% with a 2-year yield of 4.90%. We've got West Texas Intermediate crude oil now higher by 0.9%, 81.11 a barrel on WTI. Spot gold up 0.1% at $18.91 the ounce, while Bitcoin is now down by almost 6%. Bitcoin at 26,023. Estee Lauder's profit outlook for the fiscal year below estimates, a sign the beauty company sees continued struggles in its crucial travel retail business in Asia. Estee Lauder shares, they're lower now by 2.8%. So again, recapping, the Dow higher. We've got the S&P, NASDAQ both lower, with the S&P trading down by 3.5 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charles, thank you very much. Charlie Pellet there with your Bloomberg Business Flash. Now, I have been covering the automotive industry for a couple of decades, and as a result, I kind of know everybody that works in the industry. So oftentimes these manufacturers will give me cars or motorcycles to test drive for a week and figure out, what the product is like, which is, I think, very helpful in my reporting. This week, I'm driving a car from a brand that's very close to my heart. It's an Audi Q8 e-tron.
Audi Q8 e-tron. All right,
which is a little bit confusing, but basically it's their biggest SUV that's powered solely by batteries. And
oh, nice. I'm looking at it.
Well, we have video of it as well. So if you're listening, you can go to youtube.com. and just type Bloomberg Radio and you'll see this vehicle. Now, close to my heart because the first car I ever bought was an Audi A4 Avant, the station wagon version.
Sure.
That was not battery powered back in 2000. That was a 2.5 liter turbo diesel, which I loved so much. Same color, pretty much, and the interior felt the same. Everything kind of felt the same. The only difference is the powertrain. I want to bring in Kyle Stock. He is a senior correspondent for Bloomberg Business Week. He covers the car industry very closely as well. And Kyle, first of all, I'm not sure if you've driven this Audi, but if you've driven almost any Audi, the experience is really similar, and I think that's what they're going for.
Yeah, and it's like very techie luxury, right? I mean, it's they do this very well with the screens, with the digital dials, with the the real-time map information. It's a spaceship cockpit, pretty much.
It is, but in like an understated way. So they have, obviously, tech is their thing. I think their motto is Vorsprung durch Technik, which in German it means advancement through technology. That's what they've always done. Everything in the car is luxurious, and it's almost perfect in a refined kind of way, not in a flamboyant, like in your face kind of way. You're not drowning in leather. There's not a 55-inch screen, but there's exactly as much as you need, which I think is really cool. But I don't think they've cracked the whole battery tech thing because the range just isn't as impressive as other electric SUVs, and you don't get, Kyle, the kind of, punch you in the gut acceleration that you do in other electric vehicles.
Yeah, you're talking about the Q8 you were just in?
The Q8 e-tron, which is their new version of the e-tron. Now they're calling it the Q8 e-tron, even though it's not nearly as big or as special looking as the gas-powered Q8. But yeah, they don't seem to have the get up and go that other EVs have, or 300, 400 mile range.
Why is that? I thought it isn't an E. You don't talk about horsepower anymore, do you? Or
you do. You can talk about horsepower equivalent, and this one has 400 horsepower equivalent. Don't get me wrong; it's not slow, right? 0 to 60 in like 6 seconds, which for a gas car is fast.
Right.
But for an EV, I mean, Kyle, we're looking at the Kia GT EV6 or whatever it's called, does 0 to 60 in 5 seconds. Like these EVs are beating Porsches off the line.
Yeah. Well, part of the equation you're seeing here is that Q8, and a lot of the Audis are big cars. For one, they're heavy. EVs are heavy. And the content they put in there is heavy. So, you have seats that massage you. You have all the heaters. You have all the electronics. You have all the, the luxury trappings and trimmings. And that, weighs on a 0 to 60 time. But it is notable that, all the Mercedes electric SUVs are super heavy too. And those things are quick. The BMW iX, which is their new...
Like a bat out of hell.
Yeah, that's pretty quick.
Hey,
so
Kyle,
to choose your own adventure, the Cadillac Lyriq is another one in this class that's honestly really nice and kind of understated like these Audis. They are subtle with their choices. It's not all screens. It's not all, theater and drama and flashing lights.
But Kyle, what are the EV manufacturers, what are they really marketing here? Or what are consumers finding important? Is it range? Is it that it's 0 to 60 that Matt focuses on? Is it screens? What are they really marketing on?
So they're really, it's funny. It used to be range. Then it went to sort of charging time, like high-speed charging. You won't have to wait more than 10 minutes. And now it's sort of drifting into this like no compromise zone. Like you can have the giant SUV you want with all the trappings and trimmings, and it will go far enough and it will charge fast enough, and you just kind of don't worry about it. Mercedes, like all the Mercedes electrics, except like the really entry-level ones, have very impressive range figures. A lot of them are over 300 miles, and they're frank about it. They say if you buy a Mercedes, you don't want to have to worry about range. And then there's another slice of the market that is really going after the performance. Like Matt mentioned, that new Kia GT. Audi has a couple electric GTs that are just kind of bonkers. The Porsche, of course, and they're thrilling to drive.
You know what? The funny thing is, and this is the only time I think I've ever said anything like this in my life.
Oh, here we go.
Even though it's not the fastest, even though it doesn't have the most range, this might be the one that I would buy if I were looking for a BEV SUV because the road handling is so nice. The air suspension is so luxurious because it has everything you need, but not a thing more. And because I've grown up with Audi kind of in my blood, I really like it. It starts at 75 grand, which is expensive, but it's not as expensive as, a Mercedes or the BMW iX, which is ridiculously expensive, but it is more than the Lyriq and certainly more than the Kia.
That BMW starts at 87. The Lyriq, I think,
what's
is
a
one
Lyriq?
of those.
The Cadillac Lyriq.
Oh, okay. I got you. Okay.
Yeah, the Lyriq, that thing starts at basically 59,000, and it's a lot of car for that money. I mean, 59,000, you can get an electric Kia. It's really
true. A Nissan Ariya costs about that much when you have the good one.
Exactly. I mean, Cadillac's not making a lot of them. It costs extra to get all-wheel drive and the Super Cruise stuff. But that car, there's a lot of value there at that price point.
So Matt, why don't you get what's Mrs. Miller driving? She's not driving an
She
EV?
drives a Volvo XC90 T8, and it's a hybrid. It's not a fully electric
so you're
car.
kind of there.
And she's so in love with it, she says, you can pry this truck away from my cold, dead hands.
Okay, so we're not going there.
But, I think it's fine. I would go hybrid as well right now because I don't think the infrastructure is quite there yet, Kyle, for a full EV. And there's such great choices. The Volvo's a nice one, especially for my wife. I like the BMW X5 hybrid because it actually has the inline six, the incredibly refined BMW engine.
Inline six, that's an internal combustion engine.
Yeah, but inline six and a 25 kilowatt battery, so it's got both.
All right.
But what do you think, Kyle, about full EV versus hybrid?
I'm all in, man. I think it's there. I think the charging is getting there. You'll see, we're doing a big piece. You'll see it in the next week or two about how much infrastructure went in the past year.
Nice.
And then Biden, $5 billion is going into charging in the next 12 months from the Biden administration. Not 12 months, the next probably 24 months. But those stations will start popping up. I live out here in Colorado, so cold weather's a deal, elevation's a deal, wind's a deal. But I haven't had a problem. And I think it's getting there. But I'll tell you, the Goldilocks rig that I really like, Matt, I just had the Mercedes GLE 450E, which is a hybrid and a serious hybrid. So this thing, like standard great Mercedes SUV, goes 50 miles on a charge, which to me is kind of a magic number because you're hardly ever burning gas if you have that kind of range, and you have the gas if you need it, if you're going farther. I love this car. I don't know if you've been in it yet.
I haven't tried it out. I definitely would like to, but for now, I've got to give this Q8 e-tron back. And it's a little bit of a bummer because you get in the flashy special cars and they're kind of fun and interesting to drive, but they're also a lot of work. And this Audi, to me, the perfect car for commuting. It's executive, it's German, and
everything you like. All right, Kyle, thanks so much for joining us, and we'll get back to you on this, some more car stuff. Kyle Stock, senior correspondent, Bloomberg Business Week. What is Matt Miller driving? We're going to do this more often because it's always fun to talk cars, and we'll get some smart car people on here. Right now, let's talk world and national news with Nancy Lyons.
Thanks, Paul. President Biden is meeting with the leaders of Japan and South Korea today at Camp David. They're expected to discuss ongoing threats posed by China and North Korea, as well as the need to set up a better way of communicating. Biden spoke ahead of their discussions.
Our countries are stronger and the world will be safer as we stand together. And I know this is a belief we all three share. And I want to thank you both for your political courage that brought you here. And I'm looking forward to us having a great meeting, but continuing these meetings.
Biden and the other leaders will be holding a joint news conference in about an hour and a half to discuss what was accomplished today. You can listen here on Bloomberg Radio. Japan's prime minister did commit $2 million from his country to help those impacted by the wildfires in Maui. Republican rivals of former President Trump are in Georgia, where they've been rubbing elbows at an event called The Gathering. As Trump faces charges in Fulton County, his former Vice President Mike Pence, Florida Governor Ron DeSantis, former New Jersey Governor Chris Christie, and 3 other GOP presidential hopefuls are all in Atlanta today. Donald Trump, facing now 4 indictments, was planning a news conference for Monday to present a report that he said would totally exonerate him. But that plan has changed, and it's now canceled, apparently on the advice of his attorneys. Bloomberg's Zach Cohen says that doesn't mean the former president will give up efforts to capitalize on the indictments.
Trump and his team have been pretty clear that they want to use these indictments, both in Georgia and Washington, where prosecutors have charged him with trying to overturn the 2020 election, as an opportunity for him to re-air his grievances and his unsubstantiated claims of sufficient voter fraud to make up the difference in an election he did lose by 7 million votes.
Again, Bloomberg's Zach Cohen in Washington. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow higher, S&P, NASDAQ. They are both lower, on track for a losing week. Another losing week, 3 in a row for the S&P 500 index. On the week right now, we've got the S&P down by just about 2.2%. Right now, the S&P has been swinging between gains and losses, looking at a 3-point loss now, lower by about 0.1%. The Dow higher by 44 points, holding on to a gain of 0.1%. NASDAQ 100 index down 0.3%. The NASDAQ Composite Index also lower by 0.3%. Bitcoin down 6% right now, back below 26,000 at 25,985 on Bitcoin. Spot gold up 0.1%, $18.90 the ounce. West Texas Intermediate crude up 1.2%, $81.33 a barrel. The 10-year yield 4.23%, with a 2-year that's yielding 4.91%. As for the overall market backdrop, Dave Kudla is the chief investment strategist at Mainstay Capital Management, and he was our guest right here on Bloomberg Markets.
You know, I think we got maybe a little bit extended in July, and we had a 5% pullback earlier this year with issues with the banks. This one is, you know, with yields rising, maybe China also is a little bit of the catalyst for another pullback right now, 5%, probably a little bit further to go.
And you can hear more of the conversation with Dave Kudla on the Tape podcast. You can download it wherever you get your podcast. Deere shares after earnings are slipping as investors question how much longer the boom in sales of tractors and other farm machinery can last amid slumping crop prices. Deere shares, they are down by 4.4%. Rival AGCO, which makes, among other farm machinery products, Massey Ferguson tractors, AGCO down by 1.3%. And WeWork, the troubled co-working company on the brink of collapse, is moving forward with a 1 for 40 reverse stock split in a bid to save its listing on the New York Stock Exchange. WeWork down by 11.2%. Recapping stocks mixed, S&P little changed, on track for a losing week, down now by 1 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, and we are streaming live as well on YouTube, so just head over to that internet thing and search Bloomberg Radio. A bunch of retailers have been reporting over the last week to 10 days, and I think the takeaway for me at least was good results in the quarter just passed, but boy, they remain cautious on their outlook. Let's check in with somebody who does this stuff for a living. Nicole Larson, she's manager of National Retail Research for Colliers. Nicole, thanks so much for joining us here. Again, some pretty decent results. The consumer seems to be hanging in there, but I guess understandably, a lot of these big retailers are remaining cautious in their outlook. What's your view?
Yeah, so July was a pretty solid month for retail. You know, there was a rise in sales for sporting goods. Online retail was really fueled by Amazon's Prime Day. Restaurants are also seeing a boom. What we're really seeing is that consumers are becoming more selective with their purchases, and they're adapting their habits in response to, you know, a more challenging economy. They really lack the confidence to spend big right now.
So, has the consumer then run out of excess savings? I mean, that's been a debate, but it seems like the consensus is now going to yes. Certainly for the bottom 3 quintiles or bottom 4, there's just no more money left.
I mean, credit card spend is definitely up. We are certainly seeing that across the US. What we are noticing is that people are being very selective with their purchases, in the sense that they'd rather indulge in maybe things that they find worth it. For example, service spend is still very high. Like I mentioned, restaurant spend is up. People continue to, you know, treat themselves, whether that's going to get their nails done. The beauty sector saw 8%. Yeah, treat yourself. That's my motto. Beauty sales were up 8%. We saw Ulta store visits were up 20%. And Sephora store visits were up 27% just in the month of July. So obviously people are willing to spend. I just think it's those big ticket items like maybe furniture or sort of like home improvement. Auto sales obviously were down as well. Just don't think people are ready to spend big yet.
Is this just, or I guess to what extent is this just kind of a hangover from maybe some of that splurge buying when we were kind of refurbishing our homes and that type of thing? You know?
Bad comps because you already bought a car last year. If they made it for you. And I guess the big ticket items, this is what we've been hearing, Nicole, from other analysts this week, is that you already bought, the new Weber grill, or you already bought, the new TV. So those items aren't things that you have to buy every couple months.
Yeah, so what we're seeing is an improve, not move mentality. I think that was very evident when we saw the Home Depot earnings come in. Their revenue is still down, but it's, down by a more modest amount than last quarter. So again, people are, looking to refresh their homes in the sense of maybe refreshing the garden or slapping on a new coat of paint, but not necessarily, redoing the kitchen or the bathroom.
Nicole, how do we consider the inventory issues for retail America? Most retailers, have they right-sized their inventories right here? Because I know for a while there was some issues there as they were trying to draw them down.
Yeah, I think retailers are doing a better job in understanding, what needs to be in their store as opposed to what needs to be in their warehouse, especially with the growth of omni-channel retail. We are seeing retailers continue to expand. We actually took a survey and found that 50% of retailers are planning to expand in some form of degree, and especially their most commonly requested format is going to be that omni-channel. So they might not even have as much inventory in store anymore. We're also starting to see these more like entertainment, interactive store formats where they don't even have the merchandise to give you in the store. You just sort of see the merchandise. It's like a showroom essentially set up. You go, you pick out your merchandise, and they'll actually send it to you through the mail.
What is actually omni-channel, really?
I know what this is.
I think I get it.
Buy it online, pick it up at the store. Omni-channel, multi-channel.
That's it?
That's it?
So the curbside pickup, the collection points, those services where you can just order on like a kiosk or a vending machine in store and sort of serve yourself. That's that omni-channel.
I like it.
That's how I like it. It's pretty cool. And the retailers, you have to give them credit. They've really adapted, I think.
I'd rather buy it online and pick it up at the store than look at it at the store and then wait for it online.
But people do that.
I know, but I don't like to wait.
All right. Well, you don't have to, with Amazon, you get it like the day of and the day after. All right, Nicole, talk to us about this concept of the retail footprint across America. For the longest time, the retail industry was overstored. Too many stores out there. Where are we in kind of shrinking that footprint to meet demand?
Yeah, so that was really a hot topic prior to the pandemic. And I'm happy to report that I don't think that is the case any longer. Retail tenant move-ins have surpassed move-outs already just in the first half of this year by 21 million square feet. So there's really a lot of growth happening, especially in those secondary emerging markets. So that'll be like Phoenix, San Antonio, Fort Lauderdale, and Kansas City.
Fort Lauderdale. Good stories come out of Fort Lauderdale for me. Spring break, 80s.
Oh, yeah.
Yeah.
Back then, it was the spring break destination.
It was, absolutely. All right, so what should we look for going forward, do you think, for retail spend? Is it a low single-digit growth story, Nicole?
I still think consumers are going to be pretty cautious in their spend. Again, they're going to be wiser with their purchases. So no splurging like in 2021, how we were all, revenge spending is what they called it after we were freed from lockdown. I think consumers will continue to spend on the things they really, really wish to spend on. I like to use the example of Taylor Swift. They're saying that Taylor Swift tour was fueling the economies of all the different cities that she was visiting. So it seems like the money is there. The consumers are willing to spend. They're just holding on to their dollars a little tighter for those items that they really wish to have.
All right, Nicole, thanks so much for joining us. Nicole Larson, Manager of National Retail Research at Colliers. Matt, are you a Swiftie?
Not really. I feel like she probably has some good songs, but I think people go way too far. Is she really that good?
I mean, they went crazy
to be
around
honest,
the world.
To be honest, I haven't heard anything since her 1989 album, which was a long time ago. So I got to go back and listen.
Yeah, I got to go back and listen. All right, yeah, I didn't think you were necessarily a Swiftie. John Tucker is definitely not a Swiftie, but they're all over the place. Huge concert, over $1 billion. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Yeah, I'm not a Swiftie either. Neither is my daughter. Jimmy's real about it. Well, let's go to some company news right now. A class action settlement with drivers of Kia and Hyundai vehicles. They will have to be reworked after it was rejected by a federal judge. Now, Bloomberg's Jeff Bellinger has more on that.
Lisa, drivers of certain 2011 through 2022 models charged that their vehicles were prone to theft because they lack a security device that's common on other vehicles. Videos posted online showed criminals how to steal the cars. The judge who threw out the $200 million settlement said the compensation amounts to drivers did not take vehicles' values into consideration.
Shares of Hyundai right now down about 0.7%. And thousands of abandoned EVs are starting to pile up in at least half a dozen cities in China. Bloomberg's Linda Liu has that story.
China spent a lot of subsidies to try to kickstart their EV industry. And so as a result of that, a lot of ride-hailing businesses were started to kind of help bring these electric vehicles to the masses. But unfortunately, a few years ago, China started slashing these subsidies, hitting the cash flow of these companies, and a lot of them went under. And these cars kind of ended up, in no man's land.
Now, China accounts for 60% of the world's current electric fleet. And top tech and manufacturing plants from Apple to Intel are protesting the way India introduced technology import restrictions this month. 8 American trade groups, they sent a letter to U.S. officials this week to urge India to reconsider the policy. Now, they say it will damage New Delhi's ambitions to become a global manufacturing hub. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We are streaming on YouTube, so just head over there and search on Bloomberg Radio. S&P 500 unched on the day, nothing happening. S&P up about 0.2%, and NASDAQ off 0.2%. So kind of a quiet day on the index level. Got a little bit of upside here on WTI crude oil. Want to call out Bitcoin. It is now down more than 6%. Now below $26,000 per token. So that gets your attention there as folks head for the exits on a risk-off kind of environment out there. Higher rates for longer seems to be kind of the new narrative out there over the last several trading days or so. Right now, let's head down to Washington, D.C. Nancy Lyons has got world and national news.
Thanks, Paul. Maui's top emergency management official has resigned effective immediately. Administrator Herman Andaya came under fire for not sounding alerts ahead of the island's deadly wildfires. He defended his decision earlier in the week.
Had we sounded the siren that night, we're afraid that people would have gone Malka.
Andaya's use of the term Malka means going toward the mountains. Hawaii's Attorney General has ordered an independent review of the emergency response by outside experts to assess what happened. The death toll from the wildfires is up to 111, but more than 1,000 people remain missing. Former President Trump is indicating now he will not likely participate in next week's Republican presidential debate. On Truth Social last night, he posed the question, why would I debate? He went on to write that his poll numbers over his adversaries are extraordinary. Bloomberg's Anne-Marie Hordern says if Trump does not debate on stage, he'll still try to steal some of the attention from his opponents.
Potentially, he just does his own counter-programming. And then Republican primary voters will have to flip-flop between the two if they want to see an array of different voices on a stage or just want to hear what the former president has to say.
Bloomberg's Anne-Marie Hordern in Washington. Trump has also canceled a planned news conference for Monday, citing advice from his attorneys for the change. Trump had claimed he had a detailed report which would fully exonerate him. Hurricane Hilary is moving through the Pacific with maximum winds of 145 miles an hour. The National Hurricane Center has issued its first ever tropical storm watch for the southwestern U.S. and Southern California. A watch means tropical conditions are possible in the area within the next 48 hours. The storm is expected to move out of that region by Wednesday. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Have a great weekend, Paul and Matt.
All right, Nancy Lyons, thank you very much. We appreciate that. You know, this ESG thing, trend in investing, it really, I first heard about it about 15 years ago in Europe. Hadn't heard about it before, environmental, social, and governance. And then it eventually came here to the U.S., and you know, a lot of investors said, hey, it should be part of our investment process. We should look at companies that have good ESG records. There's definitely a backlash on that here in the United States.
Yeah, because it wasn't just investors, it was also marketers saying, hey, we can use this to make more money.
Yeah,
right?
exactly.
And to me, it always kind of seemed like at least a lot of it was just a marketing ploy. So now this backlash that we've witnessed over the past year or two, really, at least according to Morgan Stanley, has created, has had some positive aspects to it in that issuers now have to be a lot more careful about labeling the products that they're selling to investors. They can't just say, hey, man, this is ESG, so buy it. They have to be much more specific because they're more likely to be called out if they're full of it.
Yep, and the so-called greenium, which refers to the price advantage that companies can reap when borrowing in the ESG market, you know what? That's largely evaporated amid the political pressure hurting sales of the bonds in the U.S. Corporations have raised about $31 billion in dollar-denominated ESG bonds this year through August 17th, a 53% slump from the same period last year. That's according to data compiled by Bloomberg. And again, it's become much more of a political issue here in the U.S., whereas when I talked to Tim Craig, head of Bloomberg Intelligence in London, he says ESG investing is more popular than ever in Europe, particularly in the Nordic region.
But so maybe it's frothier there as a result.
Maybe it is. Maybe it is. So it's interesting. We'll continue to follow the ESG aspect of investing. It's a big part of the market. Sound On with Joe Matthew. It's coming up right now.
From New York
City. For our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a bid comes back into bonds after a brutal week that evaporated 2023 gains in long-dated treasuries and sent a shudder through the corporate credit market. We begin with the big issue.
Big change in narrative.
You're getting a Fed that was hawkish and raised rates very substantially.
What is the Fed ultimately looking for? They're likely to take a look at supply-demand imbalances in labor markets to decide how much more, if at all, they need to adjust the overnight Fed funds rate higher.
Lean into a hawkish bias still.
The FOMC participants should be looking at the last 3 months worth of data.
The Fed has done so much already in terms of delivering those hikes.
These are not going to be kind of near-term policy decisions of what they may do with rates next month.
Rate hikes at the September meeting.
Maybe the Fed doesn't need to hike.
We are not certain that the last hike is behind us.
The Fed keeping rates higher for longer.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
Joining us now, I'm thrilled to say we have Mike Contopoulos of Richard Bernstein Advisors and Mark Cabana of Bank of America. And Mark, since you're sitting next to me, I'll start with you. So we'll get to Jackson Hole, but let's start with the price action because it has been intense, to say the least. When you think about the sell-off that we've seen in 10-year, in 30-year treasuries, what would you say is the key factor driving that?
Yeah, we really think it's two things. Number one, a reassessment of the U.S. growth outlook, especially after that much stronger than expected Q2 GDP print, which is several weeks behind us, but I think still lingers in the minds of many. And then questions over the supply-demand backdrop in the treasury market. And that supply-demand backdrop is daunting. We know there's a lot of supply. There's lots of questions about who is going to be the end buyer. And I think that that reassessment of how strong the U.S. economy will ultimately be, where is the neutral rate in the economy, coupled with questions around who's going to buy the bonds, has really driven the sell-off that we have seen. And it's driven the relatively unusual bear steepening of the 2s10s curve that we've seen over the last month or over the last few weeks.
And Mike, I'll bring that to you. When you think about the sell-off that we've seen in the longer dated debt, is it supply? Is it growth? Is it inflation? Is it all three?
Yeah, well, first of all, let me say it's an honor to be on with you, Katie, but also Mark. Mark and I used to work together at B of A, and I couldn't imagine a better person to talk about the rates market with. So, yeah, exactly. So we do, try to be a nice guys every now and then. Yeah, listen, I think it's a combination of factors. Everything Mark said is spot on. You have a situation where, issuance has been bigger than expected. Although, it's actually been pretty well absorbed. And, couple that with August illiquidity, what's going on with Japan, relaxing yield curve control just a little bit, and the expectations that might go further later this year. And then, of course, the thing that we can't hide at all from is better than expected growth. So I think the move makes a lot of sense. The question I have is how much higher can we really go? Right? I mean, as you know, Katie, on a secular basis, we've very much been in the camp that inflation is likely going to be stubborn. We're going to be in a period of the next 3, 5, 10 years where inflation is higher than it has been for some time for a lot of different factors. And so secularly, we see higher highs and higher lows. But on a cyclical basis, I think one could argue that we're getting much closer to fair value here and that the risks are starting to skew maybe more towards lower rates from here in the near term or over the next 6 to 9 months than appreciably higher rates from here.
Well, I really like that you and Mark are friends. Unfortunately for me, you're agreeing with each other so far. But maybe if we talk levels, we'll get to a little bit of tension here. When you say where fair value is, when you look at the 10-year yield, currently we're around 4.23%. When you're thinking about fair value, what's your gut reaction, Mike, on where that is?
Yeah, I mean, I think it's generally speaking right about here. We have a model that looks at a number of different factors, leading growth indicators, inflation, the size of the Fed balance sheet, the federal funds rate, and it kind of leads us to right around this level, right around 4.25%. But to me, a lot of what we're seeing over the last month or so is very reminiscent to what we saw last year, when you had a huge spike in yields, and then of course subsequently you had a big fall of about 80 basis points shortly thereafter. There's not a lot of new information out there other than the fact that maybe a little bit of growth has come in higher than expected, but our model suggests this is right about fair value on the 10-year.
Mark, weigh in on that. Are we heading to a 5% world?
Yeah, I know. That seems to be the buzz phrase today from some of our other colleagues in research. Look, we're already at a 5% world in some parts of the rates market, certainly at the front end. From the U.S. rate strategy perspective, though, we don't think that we're headed to a 5% 10-year world.
Okay.
We do think that you're going to see rates probably want to push higher. That's where the momentum is. That's where positioning, I think, is indicating the path of least resistance will be. But we think that rates are going to keep pushing higher. The curve probably bears steepening until you see one of two things. Number one, you see signs that the U.S. economy is indeed moderating. We haven't gotten those signals yet. In fact, we've gotten signals to the contrary that indicate monetary policy is insufficiently restrictive right now. Or the second thing that we think that the market is waiting to see is some type of negative feedback from financial conditions, which tell us that, oh wow, rates have gone far enough, and we're now seeing corporates struggle to refinance, we're now starting to see earnings get hit, or we're now starting to see de-risking in the market from investors who maybe don't think that they're being adequately compensated for being in equities or credit or any other higher risk asset, and de-risking down into higher quality and safer instruments like treasuries. So we think that that's where the market's pushing right now. Now, in terms of fair value and forecasts, look, our fair value models have 10s close to 4. Our forecasts by the end of the year have the 10-year rate at 4%. So we do indeed think we're going to hit that point where you start to see the economy moderate, where you start to see some signs that risk assets are struggling a little bit more. And we do think that it's more likely to see rates end the year lower than higher from where we are today. But you got to respect the technicals. You got to respect positioning. Positioning has been very long from the asset management community. They've been long. They've been really struggling. There's a lot of frustration in that community. And we do think that some of the more momentum-driven accounts, let's say some of the CTAs or some of the higher frequency accounts, have been in this bear steepening dynamic. And I think they're going to push it until they start to see signs of feedback, again, from the real economy or from financial conditions that say it's gone too far. Are we there yet? We don't know. We're starting to see some signs of that feedback from risk assets and into rates markets. And my question for Mike, who's much more of a credit specialist than I'll ever be, is, Mike, when is the credit market really going to care? When are we going to start to see some of that negative feedback from credit indicate to us that rates have gone high enough, that real rates in particular are high enough to start driving some of that de-risking behavior?
Mark, I think we're pretty close to that, right now. When you look at defaults in the U.S. through the first 7 months of this year, they're the highest. You've had more defaults in the first 7 months of this year than since the first 7 months of 2010. Immediately following the global financial crisis. So that tells me that there is underlying credit stress here. You look at the senior loan officers survey, and it continues to tighten, right? Credit conditions are not easy. The availability of credit is not easy. All of that is bad for corporate credit. Look at real rates at nearly 2%. That's not good for corporate credit. The high yield market in particular has a little bit of an advantage. The high yield market actually has locked in lower interest rates for some time and is arguably a higher quality high yield market than it's ever been. A lot of the junk has been pushed down into the leveraged loan market, middle market leveraged loans, private credit, et cetera. And so we think the real stress on the credit side is going to be more from the floating rate portion of the market, the leveraged loans portion of the market, the private credit portion of the market. But eventually, small leads large, weak leaves perceived strong. And so you should see that bubble up. I think that could happen at any time. I don't think it's a coincidence that, you had to get through about 4% and before you saw regional bank issues. And I think, the next shoe to drop, if there is a shoe to drop, is probably going to stem from the credit side of the economy.
And Mike, to your point on leveraged loans, you've absolutely seen defaults there outpace what you're seeing in the high yield market. And I take your point that it's a higher quality junk bond market than maybe we've seen in the past. But when you look at spreads right now, just index level spreads at 390, does that seem reasonable here, or do we need to see that get above 400? Or what are you thinking?
Oh, I think absolutely it needs to get above 400. So, the best case for high yield right now, as far as I can tell, is it's a carry market. Now, carry's pretty good. I mean, the yield on high yield is 8.5%. So I think one could make a very cogent argument that, if you think, earnings are accelerating, the economy is going to do well for the next, 6 to 12 months, I don't think it's an unreasonable argument to say I'm happy to earn carry even if I lose a couple points and make 6% or 5%. It's still not bad in terms of a total return perspective, but certainly spreads need to widen. I mean, why do we earn a spread, Katie? We earn a spread to compensate you for risks, compensate you for uncertainty. Is uncertainty going up or is it going down? Right? I would argue it's probably going up, whether that be rate uncertainty, whether that be economic uncertainty, whether that be default uncertainty or recovery uncertainty. I don't think it falls much from here. And by the way, even if it does, spreads at 380, 390 basis points, that's kind of getting to the narrow end of any sort of compensation at all. So even if uncertainty declines, you don't have a lot of upside from spreads. So I think you have to go higher from here. Then the question just becomes how much higher.
Guys, I'm sad to say we only have about a minute left. And Mark, since, again, you're on set right next to me, Mike, you got to come in next time. But since you're on set, I'll give you the last word. Of course, we have Jackson Hole next week. We get to hear from Jerome Powell himself. And the Fed minutes that we got this week, it seemed like the market took that to skew hawkish. When we hear from Powell next week, do you think he'll try to walk that back?
No, we think that if anything, the risks are that he does sound a little bit more hawkish again. Recent Fed speak has sounded more balanced. You heard that balance from Powell at the July press conference. You saw it in the minutes as well. And the balance that I'm referring to here is a Fed that's been more cognizant of risks that they might over-tighten now as opposed to under-tighten, given that we've seen some progress on inflation. We don't think Powell is going to sound that balanced. And we don't think that he is, primarily because the data flow since the July FOMC has been very strong, right? I mentioned that Q2 GDP print. We also had a very strong retail sales print. Up until recently, financial conditions had been easing further. So we think that he's going to reiterate the fact that the job's not done, they can't declare premature victory, and that they're going to see this through. And that will, we think, be heard from the market as a slight change in tone. Is he going to generate a major rate sell-off like he generated last year at Jackson Hole, where he was unambiguously hawkish? No, we don't think that's his intention. But we do think, given that he is speaking, he's going to probably sound less balanced, and he's going to skew slightly more hawkish than recent Fed rhetoric.
All right, well, we have just a week to wait. It's going to be an exciting one. Really enjoyed this, both of you. That is Mike Contopoulos and Mark Cabana. Thank you both so much.
Thanks for having us.
Up next, it's the auction block. Debt issuance gets a lift from crane manufacturer. That's next. This is Real Yield on Bloomberg.
Replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it. The product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe, and it was another day with zero sales to close out the week. If you're keeping track at home, that's 8 consecutive Fridays with no deals and 4 straight weeks where market-wide volume failed to break 5 billion euros. The primary market remains subdued in the U.S. as well. Assured Guaranty, the last company to sell high-grade debt this week, boosting 5-day tally to over $13 billion. And overhead crane manufacturer Maxim Crane Works concluding its $500 million sale of 5-year high-yield notes on Thursday. That took weekly volume close to $3 billion. Meanwhile, BlackRock's Amanda Lynham weighing in on the state of corporate credit.
There's a lot of dispersion that's happening at the corporate credit level. So if you take that index level of 375 basis points of OAS in the high yield bond market, that in and of itself is tight. But if you look under the surface, half of that universe is actually trading below 300. So there's significant dispersion between the haves and the have-nots, and that's true within high yield, between high yield and loans. Certainly, as you get up into the investment grade landscape, it's a bit more resilient. But it's going to be a name of dispersion, I think, as we move through the next 12 to 18 months, and I think that will be key for corporate credit investors.
Joining us now, I'm thrilled to say we have Westwood's Adrian Helfert and Winnie Cesar of Credit Sites. And Winnie, I'll start with you. Who are the haves and who are the have-nots in this market?
It's a great question, and I think that a lot of clients are trying to navigate that very carefully, because some of the haves have been what you would maybe not expect in a Fed hiking cycle, where you've seen the consumer still quite resilient. So some of those higher quality or even not as high quality consumer aligned names that were issuing very high coupon debt at the height of the pandemic have performed really quite well, or continued to be able to refinance some of that high coupon debt in the new issue market recently. We've also seen energy performing pretty well, just given that commodity prices are remaining quite supportive. And really the BB universe as a whole seems to be a pretty strong have-not have. And then on the have-not side of things, telecom, media, healthcare, all those sectors have definitely come under some serious pressure this year.
Adrian, weigh in on that. Where are the opportunities right now, and what parts of the market would you stay away from?
Sure. I'd say on the haves and have-nots question, it's clear that those companies that came and issued very heavily in 2020 and 2021, where we saw elevated issuance statistics from the high-yield universe, did a good job of locking in lower rates at a time when they could actually do that. Now that yields are at 8.5% on the high yield universe, you saw pretty much an issuance holiday or a borrowing holiday in 2022 as there was sticker shock. Now coming into 2023, you're seeing these companies that are providing more security on their bonds, so more collateral packages, better covenant structures. It's costing them a little bit to do that on the borrowing side, but they're getting better lending rates by doing that. So those are kind of the haves. The ones that actually locked in lower rates at a time when they could, when those markets were open because they were concerned about financial conditions dropping or rates going up, are the haves. The have-nots are those that didn't do that. And statistics for them are that we're going to see rates going higher. Some will actually benefit from this, those that actually took cash on their balance sheet because of the uncertainty. I also believe, as our partner said, around the have-nots are those that are the sectors that are in focus. Telecom, to a big degree, is in focus right now, and there's a concern around that. Some of the consumer sectors, I think, will be in the have-not sector. Interesting that airlines have done so well this year, especially in the high-grade space. They're in the haves corner.
All right, so we have a pretty nice scorecard here. I want to talk levels, and Adrian, I'll go to you on this. If you look at high yield right now, spreads are sitting around 390. Of course, we have economists tripping over themselves right now to push back their recession calls. Against that backdrop, on an index level, is 390 basis points an entry point?
I was listening to the last segment, and I really wanted to weigh in on the last segment as well with Mark and Mike. I think we're in better shape for two reasons. One is the constituency set has changed. If you look back to around 2018, 2019, around 20% of high yield bonds had security or collateral. These were secured bonds. Now we're running around 50 or 60% of that universe. So the quality is potentially a little higher. Your recovery rates are potentially a little higher. I'll bring in one other thing, which is that 390 often takes into account a risk premium or liquidity premium that is a long-term risk premium, kind of like the VIX over a long term. I certainly believe that what the Fed did in 2020 with opening up their balance sheet and buying corporate bonds onto the balance sheet reduced that longer-term risk premium, and thus it's a little bit of a different consideration. Now, if I look back at an overall histogram of where we are on spreads, we're about the 40th percentile, so not far from average on high yield bond compensation for default risk. We have defaults going up. That doesn't make it look all that attractive, but those 8.5% yields right now in a context of an equity market that could experience pressure, very much agree with the comment of old that that's not unattractive.
Well, let's talk a little bit more about defaults, Winnie, because it was interesting. We had a report out of Fitch this week that said that the high yield default rate could be as high as 5% by the end of this year, actually. If you look in July, that rate was only about 2.8%. The reasoning for saying that was that basically you're going to see speculative grade issuers seeking to address their near-term maturities and other liquidity-related stresses. When you think about a 5% default rate, I guess A, does that scare you? And B, is that just a natural consequence of higher interest rates?
So a 5% default rate doesn't necessarily scare me. It's also not our base case. We think that defaults will continue to rise this year, but around 3% by the end of the year and then to 4% by midway through 2024. Somewhere between 3 and 5% is a historic average for high yield, though I will say that there are very few average years for defaults. The range is much wider in terms of defaults spiking and then coming well below average levels. I think that to get to a 5%, you would need to see a true stagflation type scenario take hold, which would also result in the capital markets really shutting down. So far, we've seen a lot of liquidity going to high yield issuers and also to the leveraged finance universe more broadly, with money being raised for private credit funds and direct lending. So we are not particularly scared by the potential for defaults. And if you look at what current levels are pricing in, it would not say a near-term 5% default ratio.
And unfortunately, we only have about 30 seconds left. Winnie, I'll give you the last word. When you put all of that together, you think about investment grade versus high yield. Which are you more comfortable in right now?
So we're actually neutral weight or market weight, both IG and high yield. I would say we really like high yield for the carry. We do have a somewhat up in quality bias focused on double Bs and single Bs. And a lot of that is just related to the uncertainty around the direction of treasury yields. I think that if there is the bias for yields to continue to move higher, then high yield is actually the spot you want to be in.
All right, guys, not enough time. Have to have you back soon. Really appreciate your time. That is Adrian Helfert and Winnie Cesar. Thank you both. Still ahead, the final spread, the week ahead. All eyes on Jackson Hole. This is Real Yield on Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, earnings pick up on Tuesday. Macy's, Lowe's, and Dick's Sporting Goods. Wednesday is the first 2024 GOP presidential debate, and then we have the Fed's Jackson Hole beginning on Thursday. And all eyes will be on that summit, particularly on Powell's speech. But for us, that does it for now. This was Bloomberg Real Yield, and this is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
I'm John Oliphant. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets at this hour. Kind of a mixed picture in terms of stocks. We do have the S&P falling about 0.2%, 43.62, the level there. We're seeing the NASDAQ fall further. So tech stocks are really weighing on the indexes today, but the Dow Jones Industrial Average is actually up, just barely, only about 0.02%, but showing some gains. So as I said, a mixed picture. Yields are coming back down. You can see the 10-year here at 4.2448. So it had been up at 4.25, and now we're down about 3 basis points, almost that much, but a pretty high level. In fact, we're up at the kind of levels we haven't seen since last year, and before that, since before the financial crisis. Bloomberg U.S. dollar index off about 1.5 points right now, down about 0.1%, 1239, 1240. So obviously with these very high yields, that draws people into the dollar, but that started to give up a little bit of the gains that we've seen over the last few weeks. And then NYMEX crude back up today over $1 a barrel at 81.41 for West Texas Intermediate. John, what are you saying?
Well, certainly you're watching some of those energy stocks trending higher with oil pushing back higher. One of the big themes of the week outside of the macro headlines has been the retail sector. Matt, we've had so many earnings reports, Target, Walmart, etc. We're still seeing a mixed picture, though, from that group. On the one hand, you've got a name like Ross Stores with some guidance that was crowd-pleasing, so the shares are up about 5% right now. But then you've got a name like Farfetch that's getting crushed today, down more than 40%, and some particular struggles for their U.S. business. And don't go to sleep, because we've still got earnings to watch for as we roll into the end of this Friday trading session in the technology sector, which has also been busy with earnings reports of late. We are awaiting some numbers from cybersecurity giant Palo Alto Networks, and there's been a lot of conversations, Matt, on Wall Street about the fact that they are having a fairly lengthy earnings call scheduled after market on a Friday. Is there something more to watch for there? Well, we'll find out. And then, of course, one of the biggest earnings stories of the day has been Deere, where you had some pretty solid numbers in the quarter and even guidance that was above expectations. But there is this general view, Matt, that perhaps the best times are now in the rearview mirror. At least that's what some of the analysts have been suggesting with the Deere story.
Yeah, I think it's pretty weird because you knew crop prices were coming down before the fantastic earnings report and before they raised their full year forecast. But let's bring in Mike Hertzer in Chicago to cover Deere. He watches the stock, the company for us out of Chicago. Mike, what happened in the earnings report that drove the shares down? Was there anything we didn't know already that was, the reason?
They trimmed some of their guidance a little bit, particularly in South America. We're looking for flat earlier, and now it's flat to down 5%. So South America harvested some massive soybean and corn crops, and farmers there kind of misplaced some of their marketing and have some less funds to pump into the machinery. So that's kind of a signal that things might get to a little bit weaker once U.S. farmers start to harvest.
I was going to ask you a little bit about that, Mike, because I think with most earnings stories during this earnings season, we've asked about the spending power. A lot of times we ask about the consumer spending power, but what do we know about the spending reality for farmers right now when it comes to going out and buying more farm equipment?
Crop prices are still very strong, and they should have plenty of money in the bank. It's just they're going to be a little bit more conservative going forward. They do like to pay for cash for a lot of stuff, so not so impacted by rising rates, but just a little bit more tentative compared to the boom times of the last, 12 months plus.
All right, Mike, thanks so much for joining us. Mike Hertzer there talking to us about what's going on over at Deere. I want to get more on the state of big machinery and manufacturing. Let's bring in CNH CEO Scott Wine. His company has over 180 years experience developing pioneering equipment and services for farmers and builders. They're a big tractor maker as well. Scott, thanks so much for joining us. I want to get first your take on the state of the farmer. Not just in America, but around the world, we're starting to see crop prices come off. Has the farmer bought all of the equipment he or she is going to buy? Is that the concern?
You know, Matt, first of all, thanks for having me on. I tell you what we're seeing around the world is just the sustainable need for agriculture equipment over time has not diminished at all. You know, obviously we're coming off a very strong peak. You know, we were early to talk about the weaknesses in South America, somewhat politically driven. So, you know, we took our medicine early and brought down dealer inventories to a reasonable level. But here in North America, where, you know, our competitor that reported this morning is so strong, we still see very, very good demand here. Obviously, we don't expect markets to stay at this peak level of performance forever. You know, so we're being prudent and really supporting our dealers, driving retail. But overall, with the need for more precision ag, the need for better technology, better productivity and yield, all the things that we bring with new equipment, you know, we think the long-term outlook for agriculture really couldn't be better than it is right now.
What's the competition like, Scott? And, you know, for those who don't know, you ran Polaris before you came to CNH. You know, you guys brought Indian from a nothing brand to a real challenger to Harley Davidson. Can you do the same at CNH versus a Deere versus another tractor maker that you might compete against in any given market?
You know, Matt, I had a great 12 years at Polaris, and it was interesting going from being the market leader, which they still are and are still continuing to expand, to being the number 2. And so I've actually learned a lot watching what some of my competitors did there about how we should react. And really, it's filling white space with new products, driving fundamental performance, improving the relationship with our dealers. It's really about delivering on the fundamentals, and I'm really proud of the way the team is getting after that. And, you know, with the board support of acquiring Raven, you know, nearly 2 years ago now, and how much money we're pouring into R&D to give better precision, autonomy, and autonomous solutions to our farmers, you know, really just gives me a lot of confidence in where we're going and the opportunities we have.
Scott, let's dive a little deeper into that, because I would argue that your industry gets a little less Wall Street attention on subjects like autonomous vehicles or AI than, say, the average automaker. But you're talking about that investment right now. How is it influencing or resulting in product evolution for a company like yours?
You know, it's a huge part of our investment, but, you know, let's not forget, I mean, many farmers on cash crop today get in their tractors and spend most of the day on their iPhones because the tractor's driving itself with the current precision solutions that we offer. And what we're talking about now is getting to that next level where an operator doesn't need, the farmer doesn't need to be in the vehicle itself. And we'll start to bring those products to market. We have them on farms now being trialed, but we'll bring it to market for sale in 2025 and just expand the portfolio from there. But really, it's the automation, not the autonomy. So autonomy is when the vehicle can, you know, move by itself. But the automation is when the tractor performs operations that the farmer would otherwise have to do. And that gives them the opportunity to get significantly more productivity and yield from their farming operations. And we've been a leader in that. That's why our market share in combines, you know, is as good as it is around the world. And, you know, we believe we can bring that technology with machine learning, automation to more farmers and more equipment, and really help drive farm fundamentals for a long time.
Scott, what about on vehicle pricing, for example? You know, we're seeing in the traditional auto space right now that challenge of introducing new models, but at a higher price point, and trying to make those appealing to consumers. Obviously, I would imagine to a certain extent you want to still be respectful of what farmers can pay, but you're also trying to provide a lot more bells and whistles. So what goes into that math?
Well, you know, we've had tremendous challenges with inflation over the last several years, and we've kept price over cost for 8 quarters in a row. Really proud of the way the team's managed it. We're seeing our input costs come down a little bit, so taking a little bit pressure off on our costs. But, you know, what we've guided to is getting back to more of a normal price increase for our vehicles, and that's 2 to 3%. And that typically is we're driving productivity in our factories, driving productivity in our material inputs. You know, we can do that and still provide many new features and benefits to our farmers. And, you know, some of these will be in subscription type revenues, so it's not the same part of the overall. But, you know, what we've seen of late is still high prices for used equipment. And as, you know, Mike presented earlier, is talking about they're able to offset and pay cash, farmers to pay cash for most equipment. And, they do want to buy the highest end equipment that we can offer because it does give them the greatest opportunity to deliver more yield and productivity from their farms.
The New Holland T6 methane tractor, is that one of those products that you can get to farmers to help them keep their costs down and boost their yields?
That's just tremendous innovation. And I, recently read a book talking about how really the best innovation is just finding ways to adapt what others have done. And, our sister division of Iveco and FPT has been the market leader in LNG tractors for a long time in Europe. And we literally took that engine, put it into a tractor, put it into a generator, and we've got operating farm in the UK that's just purely running on the manure from a slurry pit. And we capture the methane, clean the methane, and use that to power the equipment, sell the remainder back to the grid. And that's a product and a technology and a service that we're going to roll out to further operations in the UK, then in Europe, and then throughout the rest of the world. But great opportunities for farmers to lower costs and be much more sustainable. It's actually a carbon negative environment when we operate it.
That's helpful context, and obviously a lot to continue watching in your industry. Scott, thanks very much for the perspective. Appreciate it. The CNH CEO, Scott Wine, joining us. We're going to take a quick break here. When we come back, Estee Lauder falling after miscalculated demand in the crucial Asian parts of its operations, and we'll dig deeper. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
On the next episode of The Circuit.
It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Markets. I'm John O'Loughlin with Matt Miller. Time now for our stock of the hour. And we've been watching Estee Lauder shares struggle today after the beauty giant's latest results. The company grappling with sluggish revenue in Asia, supply chain missteps, and some product miscues, Matt, that have left it trailing its French rival L'Oreal.
Yeah, absolutely. It is, I think, a fascinating story to begin with, but also when you compare it to others that have done so well, like Sephora and Ulta, it begs the question, what's wrong at Estee Lauder? Bloomberg's Simone Foxman is here to explain. And Simone, I think a lot of this has to do with where they sell the bulk of their products.
That's right, yeah. A third of their sales is Asia travel sales. And of course, as we know, the Asian consumer has been very slow to come back. In fact, pointing out on the earnings call that the U.S. and EMEA consumer doing quite well in terms of retail travel, but in Asia, it's just been slow. And part of the problem here, and Jeanette Newman really summarizes this in a great piece, it's challenging. They have a lot of supply chain issues in Asia. They did not ramp up manufacturing there. They did not ramp up distribution there in the way they probably should have, considering it's a third of their business. Therefore, they were sending merchandise to their retailers there 6 months in advance, and so when the Asian consumer didn't really come back quite as fast as everyone expected, that really took a toll on their business.
And Simone, if we're going to compare the situation to that at L'Oreal, which I was mentioning, is there something that L'Oreal has done that maybe stands out or creates more of that competitive threat?
Yeah, there are a couple things, and I think when you look at the United States in particular, L'Oreal has really grabbed market share, not just from Estee Lauder, but from a lot of the other beauty brands, the broader consumer brands in this beauty space. The things that they have done really well, one, they've appealed to dermatologists. They've gotten them to recommend their products to their patients. Patients trust their dermatologist to tell them what to use. That's one important one. Also, scale has allowed them to spend much more on advertising revenue, and they've really benefited from that. I mean, you look at their sales, they're more than double, I think $42 billion to $18 billion at Estee Lauder. And you know, the thing is, Estee Lauder is really known for that prestige high-end segment, but it looks like L'Oreal is really grabbing some share there too.
They have some big brands, right? MAC. I mean, I don't know much about the makeup space, but I know MAC and Bobbi Brown. Are these higher-end brands?
Yeah, the Estee Lauder brands are higher-end brands. Tom Ford, for example. I mean, there's things... You know, these are ones that are meant to appeal to this consumer that is supposed to be stronger, right? I mean, when we've heard from these retailers over the last week, the places, the aspirational consumers, those are the ones that are struggling. So if you're on that prestige basis, you know, people are still going to want beauty, even if, you know, the inflation's biting their wallets a little bit. But here, it does appear that Estee Lauder is just struggling with a lot of weakness. And one of the concerns from analysts is it's going to take them a long time to build this back.
Right.
They're looking to next year, maybe even their fiscal 2025.
Well, you just got to get those Asian travelers back in the international terminals. Yeah. Simone Foxman, thanks very much for covering that story for us. Meanwhile, the slow-moving influence of rising interest rates will end up torpedoing the economy. This, according to renowned Wall Street strategist Jeremy Grantham. Here's some of his interview from an upcoming episode of Bloomberg Wealth with David Rubenstein.
The deflationary forces from the tech stocks breaking in 2021, probably too big. The power of interest rates rising and depressing the real estate market, very negative, slow-moving influence. I suspect that they will once again dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but
it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer. Right. You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down.
All right, to watch the full interview with Jeremy Grantham, watch Bloomberg Wealth with David Rubenstein, September 5th at 9 p.m. in New York on Bloomberg Television. Coming up, more developments on two major IPOs expected later this year, the story of ARM and Instacart next. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is Bloomberg Markets. I'm John Oakman along with Matt Miller. And Matt, we've seen a drought of IPOs for a period of time, but we're starting to see some indications that things could pick up. Sources telling Bloomberg chipmaker ARM has tapped 28 banks to underwrite its highly anticipated public debut. Bloomberg's Katie Roof covers the sector, breaks a lot of news on the sector, and she joins us now from Los Angeles for more on her reporting. And there's a couple stories, Katie, we want to get through, but let's start with what we know about ARM at this point.
Sure, yeah. As we reported, they're working with 28 banks, which is a lot of banks, but it's going to be a big IPO, possibly the biggest of the year. They could raise $6, $7, $8 billion, so they need a lot of bankers helping them round up that amount of capital. We also have Instacart coming up, as we reported yesterday. They've been talking about it for years, and we might finally see their filing next week. They're also slated, they're aiming to go in September.
So we have seen a drought, as John said. You know, hardly anybody's been coming to market. It's a real concern for private equity as well as anybody else looking for an exit. Is that going to change, Katie, or do we continue to see a very slow calendar for IPOs?
It's definitely not going to be like 2021, where there were 5 IPOs in a day sometime. So there's going to be a handful of tech IPOs this fall, which is a lot more than there was last year, which was pretty much 0. But yeah, it's still slim pickings.
And I guess, what did the industry have to work through, Katie? Like, for example, you're constantly also covering some of the private valuations. In the case of Instacart, you get into some of the details on what the valuation had looked like behind closed doors. Did that influence when they wanted to go public?
Sure. I mean, they've actually lowered their own valuation internally. They were sort of one of the first companies to do that at their size. And so at one point they were valued at $39 billion, and now their internal valuation is $13 billion last I checked. So they are aware that market conditions have changed, and we haven't seen their financials yet. I've been told that they have, been able to keep up some of the growth that they achieved in the pandemic, but we'll see more of that in the coming weeks.
Does everybody want in on this IPO? Katie, I mean, considering that there aren't any other new issues and that it's a company backed by the most darling of stock market darlings of 2023, and I'm talking, of course, about NVIDIA, does that mean there's going to be a lot more demand for ARM?
I mean, there's a lot of pent-up demand for tech IPOs in general. If anyone wants to be investing in newly public tech companies, they haven't had a lot of opportunities in the last 2 years. So there's that. I think, obviously anything around NVIDIA, there's a lot of excitement right now. ARM they've historically done a lot in the mobile chip space, but they are diversifying. They're also doing a lot with automotive technology, Internet of Things. They're expanding to other markets, but NVIDIA, Intel, and possibly Amazon are all looking like they might be strategic investors, and they've also worked with the company sometimes as partners.
All right, Katie, helpful context. Great reporting as always. We'll be watching those IPO stories. Katie Roof joining us from Los Angeles, Matt, on the IPO story. Yes, it's interesting. You've still got some of these IPO companies from recent years that are struggling to get back to IPO levels, and tech in general has been struggling in this second half of the year.
Certainly over the last few sessions. You can see the S&P right now down 0.1%. The NASDAQ is down about 0.3%. So tech underperforming. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source
for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while up.
This is a 3 as the economic picture down. The BOK is getting ready to make.
Markets on edge, but on the edge of what? Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. with about 2 hours to go. We're looking at down markets, but just slightly. You take a look at the S&P 500. It did fight back to positive territory, and then it sank a little bit, down about 0.1%. Big tech underperforming the NASDAQ 100 off about 0.3%, headed for a third straight week of declines. But what's interesting, you're actually seeing a little bit of a bid come back into this battered bond market. The 10-year Treasury yield down by about 3 basis points. The first time we've seen yields decline in over a week. And I did want to highlight crude oil, Romaine. We broke below $80 a barrel, but we're well above it now, currently up about 1.4%.
Yeah, a lot of volatility out there in the commodities space. Let's go back to Treasuries. We had that 6-day sell-off in Treasuries, but here on the 7th, they rested. A pullback in yields this Friday, though we should point out that's not nearly enough to compensate for the losses from the prior days. Bank of America strategists warning investors right now to brace for the return of the, quote, 5% world that prevailed before the GFC. And Ed Yardeni saying the recent price action against the backdrop of increased Treasury supply, it shows the bond vigilantes are saddling up.
Usually supply and demand really don't matter that much, and that's usually because federal deficits tend to widen during recessions when the Fed's lowering interest rates. This time around, we've got the federal deficit widening when the economy is doing well, and I think the bond vigilantes are quite concerned about that.
And we just showed you that 10-year yield up about 40 basis points higher than where it was just 5 weeks ago. That 30-year up 50 basis points from where it was 4 weeks ago. We can see just how much that spike unnerved investors, a measure of bond volatility that tracks bets on how much long-term rates may move on a 1-month horizon, surging to the highest level since that liquidity crisis we had back in March of 2020. There's a lot of speculation out there about foreign central banks dumping treasuries to get their hands on dollars, but so far, we should point out the Fed's weekly data on custody holdings has barely actually budged. That means that the bond volatility may be more closely linked to an unwind of long positions and a shift in sentiment. And that sentiment shift isn't just confined to the bond market. Hedge funds boosting equity short sales in 8 of the 10 sessions through Monday. That's according to data from Goldman's prime brokerage unit, Katie. Halfway into August, we should point out that the dollar amount of bearish wagers on stocks has already more than doubled in volume relative to July.
And you take a look at the options market. What's really interesting, yesterday, 25 million put contracts traded on U.S. exchanges. If you take a look where takes us back to March, of course, when we saw that banking turmoil. So we'll see. It seems like investors are actually trying to hedge here, something we haven't really seen throughout the summer, and it may come back to earnings season. Of course, we know that this earnings season maybe didn't quite deliver relative to the lofty expectations that we've seen. The S&P 500 actually on track to fall 3% since JP Morgan kicked us off this reporting season. That is the first in 5 that we've seen the S&P 500 decline, and that's even though earnings season hasn't been that bad, Romaine. About 80% of S&P 500 companies that have reported so far have beat estimates, but you're just not seeing the reward when it comes to the stock market reaction.
Yeah, unfortunately, in this environment, not that bad. It basically equals not very good as well. Let's kick things off to the close with Ayako Yoshioka. She's Senior Portfolio Manager over at the Wealth Enhancement Group. Pleased to say she's joining us here on Bloomberg Markets to Close, I believe, for the first time. Welcome to the big program here. And let's start off, I think, with where Katie left off, and that is kind of how we assess the recent earnings season up against the valuations on some of those names.
Sure. Hi, Romaine. Thanks again for having me. Really appreciate it. So, in terms of earnings season, it was sort of better than expected, or better than feared, I should say. But when we look out into 2024, people are still expecting earnings to grow by 10%. We've had such multiple expansions so far this year. I think it's going to be tough for earnings to really produce what everybody is expecting as we go into the next 4 quarters.
Well, talk to us about kind of the main pillar we know of this economy is consumer spending. And this has been a week where we got quite a few earnings out of retailers. I think we're going to get a few more next week, including the department stores. But when you look at what we heard out of Walmart, out of Target, out of Home Depot for that matter here, does it give you confidence not only in economic conditions, but in those companies themselves?
Absolutely. I think, those companies that you just mentioned have a good pulse on the overall consumer in the United States. We do think, though, that the consumer will be pressured a little bit. A lot of the excess savings that had come through during COVID have come down. And we're going to start to see student loan payments resume in October. And that's going to take a pretty big chunk out of consumer spending, about $100 billion a year, according to estimates going forward. And so we'll have to see if that continues to pressure the consumer overall.
And we'll see how that consumer holds up. But you mentioned that this earnings season has been better than feared, maybe. But I'm curious, when you sort of dissect the different drivers here into the equity market, how much of it is the corporate fundamentals that we've been getting in these earnings reports versus what's happening in the bond market and the sell-off that we're seeing, particularly in long-dated debt?
Yes, Katie, I don't think it's a coincidence that, when at the end of July and early August, when bond yields really started to make their trajectory higher, that we started to see some of the pressure in the equity markets. Long duration assets really took a hit once the 10-year started to climb quite a bit. So I don't think those are not coincidental there.
So not a coincidence, and it seems like the knee-jerk reaction when you see bond yield spike is to sell tech, and the explanation we always get is because they have profits further out. It's the cash flows further out that matter. Is that the right reaction?
I believe it is. The valuations were also stretched as we were going into earnings season and coming towards the end of July and into early August. So I think it makes some sense in order to recalibrate the valuations for the higher interest rate environment that we are expected to be in for a longer period of time.
Ayaka, I am curious about kind of what clients are saying or asking you, the sentiment that they have right now. We know earlier this year, there seemed to be this sense of everyone sort of wanted to wait things out, and we know that there was that big rally, and then it became of, oh, well, should we jump in? Should we chase this rally? Where are they at right now on the sentiment scale?
I think clients are relatively neutral. I think they've been surprised, just like all of us have been, in terms of the resiliency and strength of both the markets as well as the economy. So they're relieved to see that that's been the case and that it's not a repeat of 2022. However, everybody's nervous because the data isn't as strong as we would all like it to be in order to really confirm that we are in a truly new bull market. I think that's still yet to be determined.
Is there any sense here that when we do get a little more clarity out of the Fed, whether it's from Jackson Hole or whether it's from the next Fed meeting, that idea that, that basically them signaling that they're done or at least close to done, do you think that would improve sentiment, or are people really waiting to see more of a movement in yields and other market metrics?
Sure. I think it would certainly help, any commentary out of Jerome Powell at Jackson Hole next week, indicating that he might be close to being done. I don't necessarily think that's going to be the case, given how data dependent they have communicated that they would like to be. And so, as we all watch the labor market and as we all watch inflation data, we will see whether the Fed will move another 25, 50 basis points over the course of the next 6 months. But I think it's really going to be about how long do they hold the rates at whatever terminal rate we get to.
All right, Ayako, this was a great conversation. Great to catch up with you. Have a wonderful weekend. Ayako Yoshioka, she's Senior Portfolio Manager at the Wealth Enhancement Group, helping us kick you off to the close here on a Friday afternoon. Interesting commentary from Wall Street strategist Jeremy Grantham. His warning for investors about rising interest rates. We're going to take a listen to his prediction and why he says it's right now out of the Fed's hands.
Plus, we dig into the latest results from Deere as investors question how much longer the sales boom can last in the face of slumping crop prices.
And are you into soccer, Katie Greifeld?
No.
Well, guess what? You have to be. Okay. England and Spain facing off in the Women's World Cup on Sunday in that final. We're going to take a closer look not only at what's going on the pitch, Katie Greifeld, but all the crowds and money that's been flowing into women's soccer. All that conversation and more in just a bit. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
All right, the U.S. dollar softer on the day, but still headed for what's going to be a fifth straight week of gains. The dollar spot index here at Bloomberg crossing back above that 200-day moving average, and it's now on its longest winning streak in more than a year. It comes just as U.S. yields are making new highs on a year-to-date basis. Joining us for more, and let's get some perspective out of Win Thin, his global head of currency strategy over at Brown Brothers Harriman. And when it's kind of interesting too. I mean, there's been so much focus on what we've been seeing in the yield space, but we kind of forget about this resurgence, if you will, of the dollar over the past 5 or 6 weeks here. The idea that whatever downdraft we saw, or whatever caused it earlier this year, has that abated?
Yeah, I think a lot of that's, first of all, hi, Romaine, thanks for having me. Yeah, I think a lot of that's in the rearview mirror right now. Between, I'd say, March and June, July, we had really peak bearishness, right? Peak dollar bearishness. We had markets pricing in massive rate cuts from the Fed because of SVB. Well, that didn't happen. We talked about underperformance in the U.S. economy. Well, that didn't happen. So really, to me, we've gone from peak bearishness to, I think we're moving kind of in the middle back towards peak bullishness. I mean, everything right now, I believe, is very dollar positive. You pointed out earlier, the yields are rising. That's part of the story. Mm-hmm. More importantly, that's reflecting what I find to be the continued outperformance of the U.S. economy. And that's being reflected in monetary policy divergence. But remember, think about the Atlanta Fed's GDP now model. It's tracking over 5% growth in Q3. If you look at U.S. financial conditions, we're as loose as they were in March of 2022, before the Fed started hiking. So to me, it's no surprise that the U.S. continues to outperform, because basically the Fed has not stepped on the gas pedal enough. And that's why I think rates will have to go higher. Fed has to do more work to do, and I think the dollar will go higher as well.
I'm curious, with some of the price action that we've seen, particularly over the past 2 to 3 weeks, and I'm going to kind of put on my conspiracy theory hat here. There's been a lot of discussion here about what foreign governments are doing, foreign investors are doing with regards to their need to get their hands on dollars, primarily because of what we've been seeing in the Treasury and the yield space globally here. Is there any credence to that? Is there any evidence of that?
Well, there's been rumblings. We know that some emerging market central banks have been intervening to help support their own currencies. To me, the movement in the Treasury space, I think, reflects in part what's going on in the FX space. That is, if you need to intervene to support your currency, you need dollars. You'll be selling dollars, and so you have to sell off some of your U.S. Treasuries. So yes, that's a theme that's been kind of rumbling up beneath the surface. There's no, obviously hard evidence of that. But I think it kind of makes sense. For instance, Indian rupee is making, new all-time lows. We have the Chinese yuan also weakening. So there are a lot of likely suspects, but right now there's no yet proof yet. But it all kind of is part and parcel of the strong dollar story.
The strong dollar story, that's what I want to ask about because, of course, currency pairs, it's a zero-sum game. Is this truly dollar strength and other currencies' weakness?
Well, I think it's reflecting both, but it's become turbocharged. That is, when you have like just one side of the coin working, where you say it's very strong here in the U.S., yes, you'll get some strength, but maybe not as much as you would think. But on the other side of the coin, we've got things really going south in the rest of the world. I mentioned China earlier. Well, we've seen all the headlines, we've seen all the data. Very bad news out of China. Eurozone slipping into recession. Earlier today, UK reported very weak retail sales. So yes, it's to me, that's where the turbocharging comes, and it's coming more and more into play. That is, both sides of that coin, I think, is dollar positive.
Well, let's wrap that turbocharged dollar bit into what we're going to get next week. Of course, we have Jackson Hole. Finally, I believe we're hearing from the man himself, Jerome Powell, just a week from now. What could Powell say, and how could that influence the dollar from here?
Well, that's tricky. First of all, no one at the Fed wants to tip their hand, ahead of the September FOMC meeting. Now, in years past, the August Jackson Hole has been sort of a test drive, a test run for Fed policymakers to sort of drop some hints. But right now, there's so much truly in data-dependent mode that I don't think they want to tip their hand, 100%. It's very much the data depends. So after Jackson Hole, we'll get one more jobs report, we'll get one more CPI, PPI retail sales before the FOMC in September. So it's going to depend a lot on that. Now, that said, I think if you look at the FOMC minutes, the statements of the last several meetings, the Fed has been very hawkish. They are really concerned that inflation is sticky. They don't want to let their foot off the brake too soon. So to me, if anything, I think it will be sort of tilted towards the hawkish side. But of course, maintain that's all data dependent. And look, the data, if you say, let's let the data do the talking, well, the data is telling us, hey, the Fed needs to hike more.
Mm-hmm. All right, Win, it's always great to get your perspective. Really appreciate your time on this Friday. That is Win Thin of Brown Brothers Harriman. Now, coming up on the close, we're going to hear from Wall Street strategist Jeremy Grantham and his warning for investors about rising interest rates. That's next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Wall Street strategist Jeremy Grantham pulling no punches. He says that rising interest rates in the U.S. will end up causing a recession. Here's some of his interview from an upcoming episode of Bloomberg Wealth with David Rubenstein.
The deflationary forces from the tech stocks breaking in 2021, probably too big. The power of interest rates rising and depressing the real estate market, very negative, slow-moving influence. I suspect that they will once again dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but
it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer. Right. You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down.
And to watch the full interview with Jeremy Grantham, watch Bloomberg Wealth with David Rubenstein September 5th at 9 p.m. in New York, right here on Bloomberg Television. Meantime, of course, Grantham, not the only strategist concerned about rising interest rates. You also have Bank of America warning investors to brace for the return of the 5% world. Joining us now to discuss those implications is Liz McCormick. She is Bloomberg's chief correspondent for global macro markets. Liz, tell us about this 5% world. Does that refer to the Fed funds rate, or are we talking about 5% on 10-year Treasury yields?
Well, first of all, you know how, let's remember our finance school days of, 5% is the base, right, for the funds rate. So they mean that for the funds rate, but then through the curve, because, we're getting there, Katie. We've had 2-year above 5% this week, or last week, and we have the long rates getting ginned up a lot. So I think they mean, this 2% inflation world we had is gone. We kind of struggled to get 2% for a while, remember? But that, now we're at above 4% funds rate. We're going to be above 5 for a while. So I think they mean across the curve, like it's a new world. Like in the old days, I was kind of having a little battle with Preeti Gupta this morning that, there were a lot higher rates years ago, not to date myself. So I think that's what they're getting at. Like we have to go back pre-financial crisis, an era where we didn't have these zero rates that the Fed would bring us to so quickly, so often.
Well, and we should point out, Liz, that I'm pretty sure that this is actually what the Fed has told us, or at least that they've been signaling for a while. while to try to prepare us for the idea that we're not going lower, and it's not in any material way for any time. I am curious if you can kind of overlay that with some of the comments that we did hear out of Jeremy Grantham. The idea here of that soft landing being, in his words, a bit of wishful thinking here. What gives you any sort of sense, based on the price action you're seeing in the market and the people you've spoken to, that a soft landing can exist with a 5% baseline?
Well, first of all, there are several other investors in Grantham's camp, right? So like anything else, we'll have to flip forward a year and see who end up being right, and some other big investors. But yeah, I think for now, people are feeling like a couple of things that, you know, although it's way down, the people are in a better shape than they were, you know, post-pandemic than in 08. We have less floating rate debt out there, so we're not getting stung on our mortgages as much as we did. Companies have more capital, there's less leverage, those kind of things that the market is like slowly adjusting better to what seems like and is a high funds rate. So there is a camp that, and I think it was Win Thin just on earlier talking about like the data. For now, the data is showing you that the economy is turning along okay. The people like Grantham and other smart people saying, you know, the Fed, eventually this is going to matter a lot and we're going to sting the economy. The folks at TCW say that. They're bullish on bonds. They say, forget the soft landing. They're looking for a hard landing. They just think that eventually the economy is going to crack. And yeah, the track record for the Fed isn't too good. You know, usually they tighten this much and they get a recession. But I think it's like one economist was saying everything is different now in the sense of we've had to say we're wrong on a lot of things. So it'll just be curious how it pans out. Maybe it can be different, you know, that the Fed for once is going to have this, you know, uber tightness and will kind of trickle along to, like Michael Gabin at Bank of America says, like sub 1% growth. It's not killing it, but it's not a recession.
And Liz, we only have about a minute left with you. I want to get your thoughts on also what we heard from Ed Yardeni earlier, saying that the bond vigilantes are quite concerned about what's going on right now in the government, on the fiscal side, what the economy is doing. When you're talking to your sources, do you get any blush of bond vigilantism?
Well, I think some people are afraid to say that because we've kind of said it and been wrong so many times. But I think Ed had a really solid point in saying that, you know, one pivotal problem here is usually we have this fiscal spending and deficits worsening when we have a recession, when they should be supporting the economy. But now we are growing and spending and the deficit is just worsening. So that's kind of something that, and we already have the Treasury Department really boosting supply. So his point is that it's kind of a different dynamic. So the bond vigilantes kind of may wake up because, and you're seeing rates go up already, because, you know, there's no sign of the deficit reversing anytime soon, and we still have sticky inflation, et cetera, like we've been talking about.
All right, Liz, going to have to leave it there. Liz McCormick there, who helps lead our coverage of this. So we'll be talking about it for a good portion of the day here on Bloomberg Markets to Close. A quick check of the broader markets here as we march towards the break here. Down fractionally on the day for the S&P, the Dow, and the NASDAQ. A few bright spots out there when it comes to small caps and cyclicals, and Bitcoin, huh? Remember that, Katie?
Barely.
Well, down back around 26,000. Stick with us. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point. What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets to Close, almost 2:30 here on this Friday afternoon. Let's get you caught up on what's happening in the commodity space. Abigail Doolittle, she's standing by right now with our commodities close.
Well, Romaine, we're looking at a pretty sharp contrast here to stocks. We have commodities higher for a second day in a row. That may actually suggest that there could be some strength for stocks at least a little bit next week. Usually commodities lead because of less liquidity. You can see crude oil up 1.1%, although down on the week on China's slowdown fears. Wheat, take a look at this. This is one of the first updates for wheat in more than 10 days, up 4%. It's best day in more than 3 weeks as traders take stock of shipping out of Russia and out of Black Sea. Copper up just slightly, and then orange juice. I love to talk about orange juice when it's moving in a big way. It's up 3%. Apparently a tropical storm might be hitting California, so it seems as those orange juice traders are on top of that. And as for the Bloomberg Commodity Index, yes, it is higher on the day, but on the week it's a different story. In fact, we're looking at 3 down weeks in a row. This after I think it was a 5 or 6 week winning streak for commodities. Not so much, Romaine, as the dollar continues to climb. That is certainly pressuring commodities.
Thanks, Abigail. And we should point out that tropical storm now upgraded to a hurricane. We'll be keeping an eye on that as the U.S. West Coast potentially gets battered by that. Meanwhile, well, there's been a lot of battering going on over there in China. You're taking a look at the Hang Seng Index right now, flirting with the bear market. Chinese stocks, Asian stocks, and all their currencies have been under pressure all week long. Dismal economic data, a potential housing crisis, and now concerns about the stability of its financial sector. Yiji joining us right now from Bloomberg News to walk us through this, and great to have you here on the program. Talk to us about some of the moves that we saw in the currency. And I know, obviously, they keep this in a tight band, but there were some relatively outsized repositionings in the yuan.
Absolutely. The currency have been under pressure, but the PBOC have been fighting back basically by setting the fixing very stronger. And in fact, today's fixing has been stronger since Bloomberg have conducted a survey among the analysts since 2018. So there's a bit of pushback from the Chinese authorities, try to contain the weakness. But this is, I think, the government is facing the classic impossible trinity problem, because in an open capital account, then if you have to lower interest rate to support the